Okay, so very good evening, all of you all. Good evening, good evening. So, voice is audible and screen is properly visible. It is not blurred, no? Okay, so pay attention. Yesterday, we did one section, we did one concept conversion of bonds into debentures. So, whenever the bonds or debentures conversion of bonds or debentures into shares, sorry, my mistake, conversion of bonds or debentures into shares. So these bonds or debentures are getting converted into what? Shares. So this conversion, no, is treated as exempt transfer under section 47. Okay, so any gain arising on that conversion will not be taxable at all, because that conversion is treated as exempt transfer. Okay, no problem. So now on conversion you are having these shares. Now when you transfer these shares, so on the transfer of these shares, capital gain would be computed and would be taxable. But this capital gain will not be only for the period for which you are holding the shares. This gain will be for that period also for which you are holding the bonds or debentures prior to conversion. So the entire gain for the entire period, starting from the date on which you have acquired the bonds or debentures, starting whatever gain has happened, that entire gain will be taxable in your hands. Now, in order to charge that, how that gain will be taxable? We will first take the full value of consideration of the shares. Okay, no? So whatever full value of consideration will be there, meaning selling price of shares, that we will take. We will reduce the transfer expenses, if any. We will get net consideration. Now out of this, cost of acquisition of the shares we have to reduce. What will be the cost of acquisition of these shares? So there is one section 49(2)(a) which says that cost of acquisition of shares to be considered here to calculate the capital gain will be nothing but the cost of acquisition of the bonds or debentures which are getting converted into these shares. So the bonds or debentures which are getting converted into these shares, whatever will be the cost of acquisition of that bonds or debentures, that cost as per 49(2)(a) will be treated as cost of acquisition of these shares. Yes or no? Now if we will take that cost, what will happen? If we will take that cost, the gain arising from the beginning, which was exempted when the transfer was exempted, when the conversion was exempted, that gain also will be charged to tax. And the gain for the later on period after conversion, whatever period you are holding the shares, for that period also the gain will be taxable. So if you want to charge the tax on the gain happening in this period as well as the gain happening in this period, this entire gain will be taxable only if the cost of bonds or debentures, you consider this cost as per 49(2)(a), you consider this cost as cost of your shares. Now, one more thing. The period of holding of the shares starting from the date of conversion till the date of sale shall also include the period prior to conversion, meaning the period of holding of the bonds also or debenture also will also be included in the period of holding of your shares, meaning that I have to add both the period of holding. So instead of watching my period of holding, instead of considering my period of holding from the date of conversion till the date of transfer, I will not take my period of holding from this date to this date. I will be taking the period of holding starting from the date of acquisition of bonds or debentures till the date of transfer of shares. This entire period will be counted. Now based on this period, if the shares are short term, the cost of acquisition, which you already know as per 49(2)(a), will not be indexed. But if based on this entire period of holding, if the bonds or debentures if the shares are long term, then whatever cost which you have considered as per 49(2)(a, that will be indexed. But the indexation benefit will be available only if the shares are transferred prior to 23rd July. Okay, then only the indexation will be available. Okay, but the indexation, if available, will not be granted only for the period of holding of the shares. No, because you are not taking only this much period of holding. You are taking the period of holding from the beginning, and the gain for the earlier period is also getting taxed. So what will happen? The period of holding will be starting from here to here, and for this entire period, you are going to get the indexation benefit. Meaning that whenever you will take this cost, you will multiply it by transfer year CII, that is the year in which the shares are transferred. That year CII you will multiply and divide the CII of the year of acquisition. Acquisition of shares? No, acquisition of bonds or debentures. The CII of this year will be divided. Getting my point? So this way your cost will be indexed. And once the cost is indexed, meaning that index cost you reduce. But wait, if the shares are transferred on or after 23rd July, meaning that even if now based on this period of holding, the shares are long term, even if indexation will not be allowed because the shares are transferred on or after 23rd July. Will you remember this? This entire thing we did yesterday. Okay, now? So now see, instead of bonds getting converted into shares, debentures getting converted into shares, now can I say preference shares can also be converted into equity shares? Possible or not? The same to same concept which we have done for conversion of bonds into shares, ditto, not a single change, will be applicable here also. So whenever you will transfer the equity shares, you will calculate the capital gain. Capital gain on transfer of equity shares. You will take the full value of consideration, meaning the selling price of equity shares minus transfer expense you will do. You will get the net consideration, and out of that you will reduce the cost of acquisition of equity shares. Now what will be the cost of acquisition of equity shares, guys? Section 49 2A, no, 2A E will be applicable now. Here it was 49 2A, yes or no? Now here it will be 49 2AE, and as per 49 2A E, whatever the cost of acquisition of this preference shares was there, as per 49 2A, that will be treated as cost of acquisition of your equity shares. Yes or no? And the conversion of preference into equity, this conversion is also exempt transfer as per section 47. So the conversion of preference into equity is an exempt transfer. For example, you are having 500 preference shares. The cost of preference share was 1 lakh. And those preference shares got converted into 1000 equity shares. And the value of the 1000 equity shares as on the date of conversion was 1,50,000. So 50,000 gain is there, but that 50,000 gain will not be taxed right now on conversion. That will be taxed when the equity shares will be sold. So in order to charge the tax on that gain, which is getting exempt because of exempting the conversion, yes or no? In order to charge that gain, 49 2AE says that the cost of the preference shares, cost of acquisition, will be taken as cost of the equity shares. Getting my point? And the period of holding of the equity shares, that the date on which you acquire the equity shares on conversion, from that date the equity shares will be held. So the holding period of the equity shares will also include the holding period of the preference shares, because the gain for that period is also getting taxed. That is the reason why you are taking this 49 2A, cost of preference shares as cost of equity, no? So if the gain for that period is also getting taxed, along with the gain for equity shares. So why are you just taking the period of holding of equity shares? Include the period of holding of preference shares prior to conversion. So your period of holding will not start from conversion to transfer. No. Your period of holding will start from date of acquisition of preference shares till the date of transfer of equity shares. Getting my point? So for this entire period, whatever gain is there, that is getting taxed. Hence, take the entire period of holding. And if based on this period of holding, the shares are what? Short term. Cost you already know, 49,280. That cost will not be indexed because the asset is short term. But based on this period of holding, if the shares are long term, then indexation benefit will be available. Cost you know, you will have to index this cost also. If the equity shares are transferred on or after 23rd July, before 23rd July, then the cost will also be indexed. Yes or no? And how will you take the indexation? You will take the cost as per 49,280 multiplied by transfer year CII, the year in which the equity shares are transferred, that year CII you will multiply, and divided by CII of conversion year. No. Divided by the CII of the year in which the preference shares are held. Hello, sir. So this year CII you will divide as acquisition year CII. The same thing, same concept which was there, that same concept is applicable here also. Yes or no? Now pay attention. This is what we have discussed. Okay. Conversion of debentures. See, this concept we did yesterday. This concept, conversion of bonds into shares. This concept we did yesterday. Okay, no? Now the same concept, I have taken one example also. This same example was taken by me yesterday. Hello, sir. We have solved this also. Okay. Next one. Now conversion of preference shares into equity shares. I have just completed this. What it is saying? Same treatment as discussed above. In the case of conversion of bonds, debentures into shares, same treatment you are supposed to give. But the cost of preference shares converted into equity shares shall be deemed to be the cost of acquisition of equity shares as per section 49(2)(a). Just the section number will change. That's it. Okay. Now, section 51 we have already completed yesterday. Advance money received and forfeited. Sure. Next one. Now, zero coupon bonds. Have I discussed zero coupon bonds with you? Zero coupon bonds. Do you remember? We did different types of bonds. That time only the zero coupon bonds was discussed. What happened in the case of zero coupon bonds? Zero coupon bonds is your asset? Yes, it is my asset. Its maturity or redemption is also treated as transfer. So if zero coupon bonds is your capital asset, its maturity or redemption is your transfer as per section 247. In the definition 2 subsection 47, the maturity or redemption of zero coupon bond is also treated as a transfer. So whatever gain which will realize at the time of maturity, that gain will also be charged to tax. And how to charge that gain to tax? Simple. On maturity, whatever face value, whatever amount you are receiving, you will get the amount equal to the face value, no? So for example, the face value of the bond was 1,000. So on maturity, you are going to get 1,000 rupees face value as your maturity proceeds. That will be treated as your full value of consideration for the transfer. Yes or no? For this transfer, what will be the full value of consideration? The face value of these bonds. Yes or no? Minus transfer expense. No transfer expense, then leave it. Net consideration. You will reduce the cost of the zero coupon bonds. That means at what cost you acquired the zero coupon bonds. The amount at which they were issued by the issuer. The company who issued these bonds to you, at what price it was issued to you, that was your price. That was the price at which you acquired them, no? That was your cost of acquisition, known as issue price. So the price at which they were issued, that price is known as what? Your cost of acquisition. That is your issue price. Yes or no? So you reduce the issue price out of this full value of consideration. Yes or no? You will be directly getting the capital gain. No need to do any indexation. Remember this thing. Why? Because zero coupon bonds are ultimately bonds. and in the case of all bonds or all debentures, indexation benefit is not granted. Bonds should be capital index bonds or they should be sovereign gold bonds. Only then you get the indexation. That too also if you transfer them prior to 23rd July. If you transfer them on or after 23rd July, you don't get the indexation benefit for them also. But for zero coupon bonds or any other bonds, even if they were transferred prior to 23rd July, there was no indexation benefit available. And my dear friends, remember one thing. For zero coupon bonds, you are supposed to take 12 months. You are supposed to check 12 months as period of holding. 4 assets. Do you remember? Listed equity shares, units of equity oriented mutual fund, units of UTI, and last one is zero coupon bonds. For these 4 assets, we check 12 months of period of holding. So if the period of holding of the zero coupon bonds is 12 months or less, then you know the cost of acquisition. What is the cost of acquisition? Issue price. That you reduce without indexation. But if the period of holding of the zero coupon bonds is more than 12 months, that is the date on which you acquired them, the date on which it was issued, till the date of their maturity, this is the period of holding. Check 12 months, yes or no? If the period is more than 12 months, then they are long-term capital asset. And even if they are long-term capital asset, their cost will be taken as issue price, but that is not allowed, as no indexation will be allowed for this cost. Will you remember this? So this was your zero coupon bonds. How to calculate the capital gains on zero coupon bonds? Yes or no? Basically, we are doing section 47 only. In 47, we checked two transfer. First transfer under section 47 we took. See, if I say that exempt transfers, if we talk about exempt transfers, which we are supposed to see for our CA intermediate syllabus. So exempt transfers are given under section 47. Yes or no? So in your section 47, transfers which are exempt, first transfer I have considered that conversion of bonds or debentures into shares. So this conversion will be treated as exempt transfer. And whenever you will transfer these shares in the future, what will be the cost of acquisition of these shares? Cost of acquisition of these shares will be taken under section 49 2A. What will be the cost? The cost of acquisition of bonds or debentures converted into shares. That cost of bonds or debentures will be treated as cost of acquisition of these shares. Yes or no? And period of holding of bonds or debentures also included in period of holding of shares. Second thing. This is first thing. Second thing. And third thing. Indexation if any. Indexation if any, with effect from previous year in which shares were acquired. No sir. The previous year in which the bonds or debentures were acquired. From that date you are supposed to take the indexation from the very beginning. Yes or no? Getting it or not, friends? Sure, no? This was the first exempt transfer. Now second exempt transfer, same, copy, paste, write down, copy, paste. Conversion of what? Now it is conversion of preference shares into equity shares. Into equity shares. Now whenever these equity shares will be transferred, what will be the cost of acquisition of these equity shares? It is given in 49 2AE. What you will take? Cost of acquisition of preference shares converted into equity shares. Those shares which are converted into equity shares, whatever will be the cost, that will be the cost of your equity shares. Period of holding of preference shares also included in the period of holding of your equity shares. Yes or no? Then indexation, if any, will be given with effect from the previous year in which equity shares were acquired. The answer is no. With effect from the previous year in which the preference shares were acquired. From the very beginning you are getting that indexation benefit. Yes or no? So what we are going to do now? Now the next exempt transfer we are going to do. See, we were talking about bonds now. Hence I had a discussion about zero coupon bonds also. But zero coupon bonds transfer is not an exempt transfer. Yes or no? The transfer of zero coupon bonds is a taxable transfer. Transfer by maturity or redemption is a taxable transfer. And how will you calculate the capital gains? That I just discussed with you. Okay. Now pay attention. Now the next transfer which is treated as an exempt transfer, that is this one. See this point I will discuss later on, little bit later. This point I will discuss later. I am here to discuss 50D. I have already discussed yesterday. When you cannot ascertain the full value of consideration, the assessing officer is free to take the fair market value of the asset as the full value of consideration. Yes or no? If the full value of consideration cannot be ascertained, cannot be determined, that is 50D. Now 55.3 I will discuss later on. Okay, no? Section 47, the next exempt transfer I am talking. Now if you will understand this transaction, no, all the remaining transactions you will easily understand. Very easy. But you will have to pay a little bit attention to this transaction. Very easy. This is also easy, but you have to pay a little bit attention over here. Okay, no? Pay attention. See. Section 47 says the next transaction. See, first was this conversion of bonds into shares, and second one was this. I am talking about the third transaction, exempt transfer. If any capital asset is transferred by the HUF to its on its partition, to its members. So that transfer made by the HUF will be exempt transfer in the hands of HUF. So no capital gain is supposed to be charged in the hands of HUF when HUF will transfer this asset on its partition to its members. Why, sir? Logic, reason, simple. If I am HUF, partition is happening, whatever asset which belongs to me, I will hand over to my members. Are you going to give me anything for that? Will I get any consideration? So if I am not going to get any consideration, so gain up to the date of transfer, whatever appreciation in the value has happened, that appreciation I will not realize only, no? Am I going to realize that appreciation? For example, I acquired the asset, HUF acquired the asset for 1 lakh. And today on partition, today I am transferring that asset to my members. Today the value of the asset is 5 lakhs. So from 1 lakh, the value of the asset has become 5 lakhs. That means there is an appreciation in the value of asset when I was holding the asset. Yes or no? But that 4 lakh appreciation in the value of my asset will be realized by me only if I transfer, only if I sell the asset for 5 lakhs, no? And I get the consideration. If I'm not getting any consideration, meaning that this 4 lakh rupees of gain happening during my period of holding is not realized by me. So why should it be taxed in my hands? Getting my point? So if you are an HUF, what will happen? You have acquired one capital asset. For example, the date of acquisition is 11th November 2011. 11th November 2011. Meaning, previous year 11-12, the HUF has acquired the asset. What was the cost of the asset? 1 lakh. Example. Now, the partition is taking place. But before partition, HUF has also incurred some cost of improvement of 40,000. Getting my point? Now tell me one thing, if cost of improvement of 40,000 has been done and after incurring cost of improvement in 15-16, partition is taking place in 18-19. And on the partition, the same asset which belonged to the HUF, now that asset is given to one member. For example, the name of the member is Mr. X. So to Mr. X, the asset was given. The time when the asset was given on partition to Mr. X, at that time the fair market value of the asset was 1,50,000. So can you see there is an appreciation in the value of asset from 1 lakh to 1,50,000? No, there is an appreciation in the value by 50,000. Actually speaking, there is no gain of 50,000. There is a gain of only 10,000. Why? Because 40,000 improvement is also done. So total, if you will see, what is the cost of my asset? 1,40,000. The asset whose cost is 1,40,000 including cost of improvement, its value is 1,50,000. Still I am having 10,000 of what? 10,000 rupees of appreciation in the value. But will it be taxed in my hands? Come on, tell me. Should it be taxed according to you? If the HUF would have sold that asset for 1,50,000, then only this gain would have realized, no? So if the gain is not getting realized, because HUF is not getting that 1,50,000 consideration from the member, then why to charge this gain in the hands of HUF? Hence, what did I say? Hence, in the year 1819, when the HUF will transfer its asset on partition to its member, at that time this transfer will be treated as exempt transfer. Hence, whatever gain arising in this period which is not realized in the hands of HUF will not be taxable at all in the hands of HUF. Wait, does the government want to charge tax on this amount? Yes, the government wants to charge tax, but not in the hands of HUF because it is not realized in the hands of HUF. Hence, the transfer is exempt. So, in the previous year 1819, no capital gain taxable for HUF, since transfer of capital asset is happening on partition. This is treated as exempt transfer. So this transfer is an exempt transfer. In 1819, no capital gain will be taxable in the hands of HUF. Now tell me who is having the asset? Member is having the asset. Now this asset will be later on sold by the member, transferred by the member. When the member acquired the asset, come on, tell me, member acquired the asset on partition. At that time, the value of the asset was 1,50,000. So when the asset came to me, at that time, the value of asset was 1,50,000 only. And now that same asset, if I am selling, member will say, if the same asset I am selling in previous year 24-25, on 9th of June 2024, I am selling it for 2,40,000. So there is an appreciation in the value of asset when I was holding the asset. What is that appreciation? 90,000 rupees appreciation happening in my hands. But don't you think that this 90,000 appreciation will be realized by me now? If I'll sell the asset for 2,40,000, I'll get 2,40,000. So in that 2,40,000, will I receive this 90,000 of appreciation? Will I realize this 90,000 of appreciation? Yes. Not just this, the appreciation which was prior to my period of holding, appreciation for the period of holding for which the asset was held actually by the HUF, even that appreciation is realized by me only, no? By selling the asset for 2,40,000. Getting my point? So don't you think both the appreciation should be taxable in my hands? Meaning from 1 lakh to 1,50,000 appreciation is 50,000 that I am realizing. And from 1,50,000 to 2,40,000, this 90,000 of appreciation, even this is realized by me. So total appreciation I am realizing, total gain which is realized by me as a member on selling the asset is how much? 140. That 140 entirely should be taxable in my hands. So it will be taxable only if from my selling price I reduce this cost or I reduce this cost. Come on, tell me. Whenever the member will sell the asset, he will calculate the capital gain. He will take the full value of consideration as 2,40,000. But now he will have to reduce the cost also, no? So what will be the cost of acquisition which the member will reduce? Member will say, see, the asset came to me, at that time the value was only 1,50,000. Hello. And in my hands, For the period for which I am holding the asset, only appreciation 90,000 has taken place. So I will pay tax only on 90,000. So member wants to take this 1,50,000 as what? As cost. Will the member be allowed to take this 1,50,000 as cost? The answer is no. This only 90,000 is not realized by you. The gain for the period for which the asset was held by the HUF, even that gain is realized by you. And if you will take this amount as your cost, out of 240, if you reduce 150, only this gain will be taxed. We don't want to charge only this 90,000 in your hands. We want to charge this 50 also in your hands. How that will be possible? Instead of reducing cost as 1,50,000, reduce the cost 1,00,000. So whatever will be the cost to your previous owner, what did I say? Member, whatever will be the cost to HUF, meaning whatever will be the cost to the previous owner, that cost will be deemed to be your cost of acquisition as per 49(1). So now there will be one section which will be applied in the hands of member. See, this is not the normal asset which the member is going in the market and buying for 1,50,000. Yes or no? If member would have gone in the market and bought the asset for 1,50,000, he would have taken 1,50,000 as cost. That was okay. Okay. Even if he would have gone in the market on that day, the day on which he is acquiring the asset, he would have spent this much only. So logically speaking, this should be his cost. But we did not exempt this gain in the hands of HUF to leave it only. We want to charge tax on this gain also. HUF is not realizing this gain, hence we are not charging in the hands of HUF by exempting the transfer. But at the end of the day, we will definitely charge tax on this gain also from the person who is realizing that gain, no? So who is realizing that gain? The member will realize that gain. So from member only on this realized gain we want tax. So we cannot allow the member to take this amount as his cost. Cost to the previous owner, meaning the cost to the HUF will be deemed to be the cost of acquisition of the asset in the hands of the member, in the hands of the assessee. Because assessee has acquired the asset on partition of HUF, which is a mode specified under section 49(1). So if I say for HUF the transfer is an exempt transfer, yes or no? For HUF the transfer is an exempt transfer. So if you will see, if the capital asset is transferred by HUF, for HUF this transfer is what? Exempt under section 47, yes or no? For HUF this transfer is exempt. But after transferring, whenever the member will transfer the asset in the future, no? What will be the member will calculate the capital gain. But for member, what will be the cost of acquisition of this asset? So for member, the cost of acquisition to calculate his capital gain will be 49(1). Cost to previous owner. Cost to previous owner, meaning cost to HUF, will be deemed to be cost in the hands of the member. Will you remember this? Why this cost is taken? Did you understand the logic? Hello? Member will be told that member, you have acquired the asset by way of, you have acquired the asset on partition of HUF. You have acquired the asset on partition of HUF. You have acquired the asset on partition. This is a mode of acquisition which is prescribed in 49(1). In 49(1), no, there are many modes which are prescribed. They are saying that if the asset is acquired on partition of HUF, if the asset is acquired by way of gift, if the asset is acquired by way of inheritance, if the asset is acquired by way of will, if the asset is acquired by way of irrevocable trust or revocable trust. So there are many modes which are prescribed in 49(1). So if you are an assessee, and you have acquired the asset by way of any of the modes which are specified in 49(1), and partition of HUF is one of those modes given in 49(1). Yes or no? So in those cases, whenever the assessee has acquired the capital asset by way of any mode which is specified in 49(1), what will be the cost of acquisition in the hands of assessee? It will be cost to previous owner. It will be cost to previous owner. On partition, you acquired, no? So for you, what will be the cost? Cost to previous owner. Cost to HUF will be your cost. By way of gift you acquired, no? Hello? By way of gift you acquired, no? So what will be your cost? The person who has given you the gift, the previous owner, his cost will be taken as your cost. Oh, you have acquired by way of will, inheritance. Wow, very good. So what will be your cost? What cost you will take for this asset? Cost to the person who has given you by way of will. Cost to the person who has given you by way of inheritance. Cost to the previous owner will be taken as your cost. So that whatever gain which we have exempted him by exempting his transfer, thinking that this gain is not realized to him, we charge tax on that gain from you, because that gain will now be realized by you. Getting my point? So tell me, here in this case, from 150 to 240, this gain will also be realized by you. And from 1 lakh to 1 lakh 50, this gain will also be realized by you. Remember, if you will sell the asset for 240, the entire gain will be realized by you. So do one thing, on the entire gain, you pay tax. But to pay that tax, we cannot take this as your cost. We'll have to take this as your cost. For you, assessee, the cost to the previous owner will be taken as your cost of acquisition. Understanding? But wait, one small thing. Any cost of improvement incurred by the previous owner on or after 1st April 2001 will also be taken as your cost. Meaning, any cost incurred by the previous owner, you take it as your cost only. You only reduce that. Why? Reason very simple. Very simple. If the HUF would have sold the asset for 1 lakh 50 instead of transferring you, if the HUF would have sold the asset for 150, how much gain would have been taxed in the hands of HUF? Only 50 or only 10? Only 10. Because out of 150, HUF would have got the deduction for cost of acquisition as well as cost of improvement both. So the gain for HUF would not have been 50, it would have been only 10. So this gain only we want to charge in your hands. It will be possible only if the cost of improvement of the previous owner is taken as your cost. Getting my point? So section 49(1) allows you to take the cost of acquisition of the previous owner as your cost. Yes or no? And also any cost of improvement incurred by the previous owner will also be taken as your cost. Meaning the exact amount of gain happening in his period was not 50, it was only 10. That only should be taxed in your hands. And in order to do that, his cost of improvement, previous owner's cost of improvement, should also be treated as your cost. Yes or no? Now tell me, are you going to pay tax on this improvement, this appreciation only, or the appreciation for the earlier period also? So why are you taking your period of holding only? In your period of holding, include the period of holding of the previous owner also. Yes or no? Because his period gain is also charged to tax in your hands. So don't take your period of holding only. In your period of holding, include the period of holding of the previous owner also. Now, you will see the period of holding from 18-19 to 24-25. No, you will see the period of holding from 11-12 to 24-25. Getting my point? Now, if this entire period, looking at this, if you say that the asset is short term, then you know the cost of acquisition, you know the cost of improvement, yes or no? No need to index. Because the entire period you checked and you say that the asset is short term. Hello? Then in case of short term gain, for you the short term gain will be calculated, and to calculate short term gain, cost of acquisition, cost of improvement is not indexed. No need to index. But if you check the period of holding from this to this entire period you checked. See, in our case, checking the entire period, can you say that the asset was short term or it was a long term asset? Yes, starting from here, if the asset is held, okay, till here the asset is held. So the asset is not short term, it is long term in the given example. So in this particular case, what will happen? Come on, tell me. Now, the cost of acquisition you will take this. Cost of improvement you will take this. Will you index both? Yes. Why? Because you are transferring the asset prior to 23rd July. So if the asset was transferred prior to July and the long-term asset is there, long-term gain will be calculated. To calculate that long-term capital gain, cost of acquisition, cost of improvement needs to be indexed. Yes or no? So, cost of improvement you have. Will it be treated as your cost? Index it. How will you index? Cost of improvement multiplied by transfer year CII, hello, divided by improvement year CII. Easy, no? Hello? Wait. Will you index the cost of acquisition? Will you index the cost? Now see, I will tell you something. Under the law now, they have said that cost of acquisition will be indexed with effect from the previous year in which the assessee started holding the capital asset for the first time. Understand. If the asset is long term, you will get the indexation benefit. But the indexation benefit is a benefit which is granted with effect from the previous year in which you start holding the capital asset for the first time. When did you start holding the capital asset for the first time? This is the year in which you start holding the capital asset for the first time, no? So you should get the indexation from this to this period only. But don't you think that it is absolutely illogical? But the law says this only, huh? Law says this only. Whenever the asset is transferred as a long-term capital asset, you get the indexation benefit. If you transfer the asset prior to 23rd July, you are going to get the indexation benefit. But that indexation benefit will be given to you. The indexation benefit will be given to you with effect from the previous year in which you start holding the capital asset for the first time, assessee. When did you start holding the capital asset for the first time? Member, hello member. When did you start holding the asset for the first time? 18-19. From that time only you are going to get the indexation. This is what law says. But wait. This was not acceptable by one of the assessees. That assessee said that bloody you are taking the cost to the previous owner as my cost. Meaning that the gain happening in his period of holding is also getting taxed in my hands. So the law wants to charge tax on that gain in my hands. Hence, this cost was not taken. The cost taken was for the previous owner. That was taken as my cost. Meaning that the gain for this period is also taxed in my hands. And I should get the benefit for that period also. Hence, the law says that in my period of holding, I will also have to include the period of holding of the previous owner, which I did. And after doing it, if I am getting the period of holding and based on that period of holding, if I say that the asset is long term, then it is logical that I should get the indexation benefit for that period also for which the gain is taxed to me. The gain for this period is also taxed to me, so I should get the indexation benefit for this period also. But what your law says? I will get the indexation with effect from the previous year in which I start holding the capital asset for the first time. If you are charging his gain in my hands, then assume no, I have started holding the capital asset for the first time with effect from the previous year in which previous owner started holding the capital asset for the first time. Yes or no? So logically speaking, I will take this cost of acquisition multiplied by transfer year CII divided by acquisition year CII. Hello? This only, no? Logically. Because this entire period gain is taxable to me. If you would have charged tax only on this period gain, no. I would have taken the indexation starting from 18-19 to 24-25. Then it was logical. And I would have taken only my period. I would have taken the indexation for my period only. But this cost is taken as my cost, meaning I am paying tax on this gain also. That is the reason why the period of holding of the previous owner is also included in my period of holding to determine the type of asset, whether it is a long term or short term. Then why am I getting only the benefit of indexation for my period? I should get the benefit of indexation for the earlier period also, no? Understanding? Absolutely logical thing. Assessing officer denied. Assessee was very adamant that no, I will take the indexation for earlier period also. And both had a big fight. That fight reached to Bombay High Court. Not Supreme Court, Bombay High Court. And Bombay High Court gave the decision in the favor of assessee only. That is absolutely correct. If the law is speaking this, no, that the indexation benefit will be available from the previous year in which the assessee started holding the capital asset for the first time. But in this case, it should be assumed. The law should be harmoniously constructed, construed, meaning the interpretation should be harmonious and not the literal interpretation. The period of holding of the previous owner is taken. Cost of the previous owner is taken. That means the law wants to say that the assessee has started holding the capital asset for the first time with effect from the date on which it was held for the first time by the previous owner only. From that date only he should get indexation. So assessee is correct. He should get the indexation starting from 11-12 to 24-25. So take this COA multiplied by this year CII divided by this year CII. Getting my point? Bombay High Court said assessee is okay. But wait, Bombay High Court judgment, no? Bombay High Court judgment does not overrule the law. Law is above all. If the law says this, then Bombay High Court judgment cannot supersede the law. If it would have been the Supreme Court judgment, then it would have been applicable for whole of India and it would have become the law of land. But is it a Supreme Court judgment? No, it is a Bombay High Court judgment. And the name of the judgment is Manjula Ben Jayantilal Shah versus CIT. You have to remember the name of this case law also. And wherever applicable, you will have to apply the, you will have to write down the name also for this judgment. So now finally, sir, what we are supposed to do? You tell me. Finally, whenever we will be solving the answers, questions, at that time, we are going to take the indexation from this to this because the law says this. Indexation only for your period of holding assessee because the law says that indexation will be available with effect from the previous year in which you started holding the capital asset for the first time. When you started holding 18-19. So you will take the indexation from 18-19 onwards. Will you remember? But there is a Bombay High Court judgment which says that the indexation should be given from beginning. The judgment is Manjula Ben Jayantilal Shah versus CIT. If you apply that judgment, that you have to write in note. You will have to give a separate note for this. As per the decision of the Honorable Bombay High Court. What did I say? As per the decision of the Honorable Bombay High Court in the case of Manjula Ben Jayantilal Shah versus CIT. It was decided that the indexation benefit will be available with effect from the previous year in which the previous owner started holding the capital asset for the first time. Assuming that the assessee has also started holding the capital asset for the first time since that date only. And accordingly, the index cost of acquisition will be this multiplied by this divided by this. Getting my point? and the resulting capital gain, long term gain will be this. This you are supposed to give in a note. And if you forget this, no, marks will be deducted, because the institute also wants you to write down your answers in this manner only. In the main answer, what you will write, friends? In the main answer, you will do the indexation only for your period of holding and you will get the calculation of capital gain. But besides the index cost of acquisition, you will write down refer note below. So in that note, what we are going to do, friends? We are supposed to write down about Manjula Bain judgment. Okay. And we are supposed to recalculate the capital gains in this note. Recalculate the index cost and recalculate the capital gain. This judgment you will apply. This entire discussion is applicable only for cost of acquisition and not for cost of improvement. Cost of improvement indexation, there is no problem only. The year in which the cost of improvement was incurred, from that date till the date of transfer. Hello? The indexation will be for this period only. There you are not supposed to see Manjula Bain judgment or this judgment or that judgment. This judgment will be applicable only if you are indexing the cost of acquisition. Now there will be no problem only, you know. What if the capital asset is transferred on or after 23rd July? Even if it is long term, there is no indexation only. So this entire discussion becomes irrelevant now. But wait, not irrelevant for our attempt. Because in our examination, they can ask you the question where the asset is transferred prior to 23rd July. Getting my point or not? So in that case, this discussion is very relevant and you'll have to follow whatever we have discussed. So can you calculate the capital gain in this case, everyone? If I tell you to calculate the capital gain in this case, can you calculate? This is a question only, but I have presented in the form of example. Wait. Please pay attention. Here. Cost of improvement incurred by the previous owner will be taken as your cost. What if you also incur a cost of improvement? That is definitely allowed. Your cost of improvement will be allowed. Cost of improvement of the previous owner is also taken as your cost. That is also allowed. Getting my point? So that does not mean that your cost of improvement will not be allowed. Your cost of improvement will also be allowed. Will you remember, sir? Everyone, sir? Pay attention. One more small thing I'll add here. What if the previous owner acquired the asset prior to 1st April 2001? Possible or not? So if the previous owner acquired the asset prior to 1st April 2001, his actual cost or the fair market value as on 1st April 2001, whichever is higher, will be taken as his cost. Meaning 55 subsection 2 clause B option will also be available in the case of cost of acquisition of previous owner. If previous owner would have calculated his capital gain, if he would have transferred the asset for 1,50,000, what cost he would have taken? He would have taken the actual cost? No. He would have taken the actual cost or fair market value as on 1st April 2001, whichever is higher. He would have ignored the cost of improvement incurred prior to 1st April 2001. So ignore the cost of improvement incurred prior to 1st April 2001 and cost of acquisition incurred by the previous owner prior to 2001 actual cost or fair market value as on 1st April 2001, whichever is higher. Take that amount as previous owner's cost of acquisition, and as per 49(1) that will become your cost. Got it, sir? Because your cost is nothing but cost to previous owner. And what was the cost to previous owner? Actual cost or fair market value, whichever is higher. And any cost of improvement incurred by the previous owner prior to 1st April 2001 is already taken care of in that fair market value. Forget about that cost of improvement also. And now indexation will start from 2001 to 24-25. But that also in the case of cost of acquisition, yes or no? And that also if you are following Manjula Bain Shah judgment. Getting my point, sir? So now, based on the information which is in front of you, please calculate the answer and give me the answer. Final figure of capital gain. Come on, do it fast. I want all of you to solve this question. Come on, do it. Did you get the answer? See, pay attention. Section 40. This no. I'm solving it now. So what you will do, see, the way in which your answer should be presented in the examination. How will you present your answer? You will write down the name of the assessee, then individual, ROR, PAN, previous year, assessment year, that all you write. Okay, no? Directly I will start from computation. Computation of what? Capital gain. Which capital gain? Short term or long term? I don't know, sir. For that, I will have to do a working note. So my first working note will be for this. That what type of capital gain I am calculating. Period of holding. Then it will be type of asset. Then nature of capital gain. Everything will be there in that first note. Okay, no? So pay attention. Then I will write down the particulars. And rupees. Now, what will be the full value of consideration? See, in this case, no, they have given capital asset. They have not told me that what type of asset is it. Is it immobile property? Is it shares? Okay, no. So in the examination, no, the same question will come. Same question, but they will mention the name of the asset. For example, they have mentioned immovable property. What? Immovable property. Then how much period of holding you will check? 24 months. Okay, no? Wait. You are selling the asset. Member is selling the asset. At what amount? 2,40,000? Sure? See, if it was immobile property, no, here they will give stamp duty value also. So that a little bit complication is there in the FVC. The basic framework will remain this only. Understanding or not? Basic will remain this only. In this, no, they will do some additions. They will take out some information. They will give some more information. Getting my point? And based on that, people say that this question was difficult. This question was this, that. No, the framework remains same. In that only they will play with you. They will introduce few concepts here. Wait, now they are selling the asset. Who is selling the asset? Member is selling the asset. But in the question they would give you that before transferring the asset to member, HUF wanted to sell the asset but could not sell. Received some advance and forfeited it. So has to be adjusted as per section 51. Provided it was received and forfeited prior to 1st April 2001 and HUF transferred it. But HUF is not transferring. Who is transferring? Member is transferring. So capital gain is now calculated in the hands of member. From the cost of acquisition of the member, any advance money received and forfeited by the previous owner cannot be adjusted. Have you received and forfeited? No, no need to reduce. This they can give. Understanding? So easy thing is this. But in this only they will try to make some additions or deletions and create some complications in the question. Don't worry at all. Every damn single thing you have learnt with me in the class itself, that will be asked in the exam. Not a single thing which will be out of my class, Everything I am talking in front of you, every possibility I am telling you that this also can happen, this also can happen. See, on every point if we will try to make one question, so there will be 500 questions in one topic. And still, all the topics are not covered. Because there are so many permutations and combinations which can happen. That is the beauty of this subject, So you first have to learn that how to apply a particular concept. Now it is not necessary that a particular concept you have applied in this question, the same question will be asked. You are very lucky if the same question is asked. But what if there are some modifications done in this question? You completely get, shocked. Oh my god, new type of question. What new type? Everything which you have done is there in the question? No. You just have to be a little bit confident. This topic, no, very easy topic, capital gain. And very less people understand this. Getting my point? Okay. So what we'll do here? FVC. What FVC will take? First of all, this capital gain, no, we are calculating this capital gain in the previous year 24-25, that is assessment year 25-26. We are computing this capital gains in the hands of member. So name of the assessee is member. Getting my point? Wait, but prior to transfer by the member, HF also transferred, no? In 1819, HF also transferred, no? So what will be the capital gains in the hands of HF? So you'll have to write down, see here, before making this calculation, no, you'll have to make the calculation in the previous year 1819, that is assessment year 1920. You'll have to write down, since HUF has transferred its capital asset on its partition to its member, comma, hence no capital gain will be computed and charged to tax in the hands of HUF, as such transfer is treated as exempt transfer under section 47. Can you write down this in your language? Same thing, we know that only we are supposed to write. Now in the hands of member we are calculating. Okay, so we'll first make the format. Okay, FVC minus transfer expense, you will get net consideration. Okay, from the net consideration you are supposed to reduce two things: cost of acquisition, cost of improvement. But with indexation or without indexation, that you don't know. And for that reason only we are going to make working note number 1. Okay, so what we'll do here, we'll prepare working note number 1. In working note number 1, we'll determine the period of holding, we'll determine the type of capital asset, and we'll determine the nature of capital gain to be calculated. Yes or no? So capital asset, what was the capital asset? Not known. Okay, so first of all I'll write down the name of the capital asset so that I understand that what period of holding I have to check. 12 months, 24 months, 36. So first of all write down the name of the capital asset. Then the capital asset acquired by HUF. When the HUF acquired that, see, 11 11 11 11 11 11, meaning previous year 11 12. So this capital asset acquired by HUF transferred on partition to its member. What is the date of transfer? 13 12 18. 13th December 2018, meaning previous year 18-19. Okay, and member sold the capital asset. Member sold the capital asset on what date he sold? 9 June 2024. 9 June 2024, meaning previous year 24-25. Now, can I say this is the period of holding of the member? Yes. This is the period of holding of member. Can I say this is the period of holding of the HUF? Yes. Both these period of holding needs to be added. Okay. So now the final period of holding should be taken from this to this. Okay. This to this. Therefore, period of holding is more than 12 or 24 or 36. Whatever may be the capital asset, based on that you write here. Okay, no? Now, therefore, capital asset is long-term capital asset and LTCG is computed. Now I'll go to my statement and computation of what? Computation of long-term capital gain. This fill in the blanks will happen. Now if I want to calculate the long-term capital gains, okay, no? Now in this I will have to write that why I have taken the entire period of holding. So entire period of holding, total period of holding I have taken, no? Total. Why I have taken this total period of holding? Since member has acquired the capital asset on partition of HUF, that is a mode specified under section 49(1). Therefore, period of holding of previous owner, that is HUF, also to be included in period of holding of member, who happens to be our assessee. Done, sir? This much you will have to write. And without these notes, don't think that you are going to get marks in the exams. Examiner will ask you that why you have done this. Sure? Now, okay. No problem in this. Full value of consideration. Now I will be doing indexation over here. I know index cost of acquisition and index cost of improvement. But for that also I will have to make notes. Okay, that I'll see. Full value of consideration. What amount I'm taking? Sale proceeds. So what was my sale proceeds? Come on, tell me. Sale proceeds was 2,40,000. Was there any transfer expense? No, sir. So my net consideration will be 2,40,000. Done, sir. For cost of acquisition, I will prepare note 2. And cost of improvement, I will prepare note 3. Okay. Now what I will say? Note 2. In note 2, I am doing cost of acquisition and cost of improvement. See, cost of acquisition of previous owner, that is HUF, shall be deemed to be cost of acquisition in the hands of assessee. That is member. Why have you done this? Why have you done this? Reason simple, sir. Copy paste. Copy and paste. Since member has acquired the capital asset on partition of HF, that is a mode specified under section 49(1). And because of this, whatever was the cost in the hands of previous owner, I am taking as my cost. Okay. So, what will be done over here? Come on, tell me. Cost of acquisition to HUF was how much? 1 lakh is equal to cost of acquisition to assessee to the member. This 1 lakh. Now I got the cost. Now I will index. Therefore, index cost of acquisition is equal to cost of acquisition into CII of transfer year divided by CII of acquisition year, and this is really important, acquisition year, whose members acquisition year, yes or no, as per the law. So what I'll do, I'll take 1 lakh into 363. Now you tell me the CII of 1819, because in the year 1819 only the member has acquired, yes or no? It is 280. So my index cost will be 1 lakh into 363 divided by 280. 129,643. 129,643. This is my index cost of acquisition, which I will write here. 129,643. But wait, here only no, I will write down further note. I will write down what? If the judgment of the Honorable Bombay High Court was followed, then indexation would have been granted with effect from the previous year in which previous owner, that is HUF, started holding the capital asset for the first time. Accordingly, ICOA is equal to 1 lakh into 363 divided by, now the CII you will take for which year? Come on, tell me. Now you will take for 11-12, the year in which who acquired? HUF acquired, yes or no? So take 254. Now tell me how much? 142,913. 142,913. This would have been the cost, and LTCG would have been, fill in the blanks, that I'll calculate later. Once my final LTCG is calculated, after that, yes or no? Just see, yes. What? 184. See, you are only telling me and you are telling wrong. 184. Take 184. 184. So this will change, huh? Tell me how much. 1 lakh into 363 divided by 184 will be 197,283. Now it is okay? 197,283. Yes or no? Correct? Okay. Now pay attention. Now index cost of improvement. Is there any cost of improvement done by the assessee? Assessee? No. But the cost of improvement is done by the previous owner. As per 49.1, that will be taken as my cost. So, working note 3. Note 3. Cost of improvement incurred by the previous owner, that is HUF, shall also be treated as cost in the hands of assessee, that is member. Therefore, COI which was incurred in 15-16 is equal to how much? It was 40,000, no? Is also taken. And why you are doing it? Reason simple. Reason you know. Since member has acquired the capital asset by way of a mode specified under section 49.1. Reason you have to give. Okay, sir? Therefore, ICOI is equal to COI into CII of transfer year divided by CII of improvement year. So COI will be 40,000 into 363. Now 254 was for this, I guess. Right, no? So 40,000 into 363 divided by 254, 57,165. This 57,165 I will write here. Done, sir. So what I will do, 2,40,000 minus 129,643 minus 57,165, 53,192 will be your LTCG, long term capital gain. But if you would have followed the Manjula Bain judgment, no, so this everything would have remained same. Only this would have changed. How much? 197,283. Yes or no? So I would have written 197,283, and in that case long term capital loss would have been there, 14,448. That is the loss, no? 14,448. So if Manjula Bain judgment is followed, I would have taken this cost and LTCL will be this much. Write down here. Sure, sir. Easy. Let's see whether we can solve few more questions or not. Okay. Come to the textbook, study mat. In the study mat, you all are going to tell me that question number 1 is done, no? Or not done? Illustration number 1. Done or not done? Not done. Done or not done? Not done, no? Page number 3.375. Done? Done, no? Very good. Okay. So in 46.2, no, I have told you the period of holding of those shares in the liquidating company. Okay, no? 2 is also done. 2 is done. 3 is done. 3. 3 is also done, no? Where is 3? Yes, 3 is also done, no? 4. 4 is done. Not done, no? Wait. Wait for some time. 4 we will do. 4, then 5. 5 is we are going to do. Because we are in section 47 only, no? So these questions are on section 47. We are going to do along with section 47, okay? 47, okay, done. Okay. So all those questions were there. Next question is question number 8. We have already completed it. 9 also we have done. Okay. 10 also we have done. That is 50B. Then after 10, 11th and all are related to exemptions. 11th, then 12th, they are related to exemptions. Okay. Come to test your knowledge. Two and 3 done. 2 and 3. 4 is also done. 5. In 5 there is a concept of section 15. Yes. 7. Have we done question number 7? Not yet done, no? Okay. This is a really good question. Mark this question important. Mark this question important. And we are going to solve this question, okay? Mr. Shiva purchased a house property. House property is purchased. He is purchasing a house property. Purchased a house property on 15 February 1979. Ayyo. For rupees 3,24,000. In addition, he also paid stamp duty at 10% on the stamp duty value of rupees 3,50,000. Wait. That time when he purchased the property, no, at that time he paid the stamp duty also, which is his acquisition cost. Yes or no? So the actual cost incurred by him to acquire the property was 3,24,000 plus 10% of 3,50,000, which he paid as what? Stamp duty. This is his purchase related expense. Okay, no? So 35,000 plus 3,24,000 will be 3,59,000. So the actual cost of the property to him was 3,59,000. Now tell me, has he acquired the property prior to 1st April 2001? Yes. So his actual cost is this much. Will he get the option to take the fair market value as on 1st April 2001 as cost of acquisition? Yes. But wait, this is an immobile property acquired prior to 1st April 2001. So he will get the option to take the fair market value as on 1st April 2001, but that fair market value should not be more than the stamp duty value as on 1st April 2001. Both the things are given below. See, on 1st April 2001, the fair market value of the house property was 11,85,000 and the stamp duty value was 10,70,000. So you have this option to take 1185, but is this 1185 more than 10,70,000? So you cannot take this fair market value. Your fair market value will be restricted to 10,70,000. So either this fair market value or the actual cost, whichever is higher, can be taken as cost of acquisition. Done? If you crack this, cost of acquisition is gone. Okay, so now what was your cost of acquisition? Tell me. So your cost of acquisition will be 3,59,000 actual cost, or the fair market value, which is restricted to the extent of stamp duty value, 10,70,000. Whichever is higher can be taken as cost of acquisition. So tell me, can I take 10,70,000 as my cost? Yes sir, I can take. But wait, if you have received and forfeited any advance prior to 1st April 2014, even that advance will be adjusted out of this cost. So what happened now? Mr. Shiva in April 2008, can I say prior to 1st April 2014? In April 2008, meaning prior to 1st April 2014, entered into an agreement with Mr. Mohan for sale of such property for 14,35,000 and received an amount of rupees 1,11,000 as advance. However, the sale consideration did not materialize and Mr. Shiva forfeited the advance. He received the advance of 1,11,000 and he forfeited that advance of 1,11,000. Yes or no? He forfeited that advance. Is it forfeited, received and forfeited prior to 1st April 2014? Yes. So as per section 51, whenever Shiva will transfer the property in future to calculate his capital gain out of his cost, that advance money received and forfeited will be adjusted. Yes or no? So can I adjust this 1,11,000 from here? Yes sir. So tell me 10,70,000 minus 1,11,000. 1,11,000, no? 1,11,000. 9,59,000 will be his cost of acquisition. Everyone. Wait, one more advance he has received and forfeited. He again tried to sell the property in May 2015. May 2015 means on or after 1st April 2014. Now whatever advance he will receive and forfeit now, no, will not be adjusted under section 51 out of the cost, because in that year only, in the year 15-16 only, it will be taxed under the head IFRS. So that year what he did, he again entered in an agreement to sell the property to Deep Shikha and received rupees 1,51,000 as advance. However, Miss Deep Shikha did not pay the balance amount. Mr. Shiva forfeited the advance, meaning this 1,51,000, no, under section 51 cannot be adjusted because this was already taxed in the previous year, already taxed under the head IFOS in previous year 15-16, no? So now this cannot be adjusted. For this you will have to give a note that why you have not adjusted that out of the cost, since it was received on or after 1st April 2014 on in May 2015, that is previous year 15-16, it was taxed, already taxed under the head IFOS in 15-16, hence not to be adjusted under section 15. The same is ignored. Yes or no? Now 959 will be reduced whenever he'll sell the property. So now see what is happening on November 2015. Now these two dates are very important. Huh? November 14 entered into an agreement, sale agreement with Manish for sale of such house for 30,50,000. So sale value, sale agreement value is the sale value, sale consideration, that is 30,50,000. Now, and received an amount of 1,50,000 as advance through account pay check. Wow, wonderful. That out of 30,50,000 of sale consideration, he is already receiving 1,50,000 as sale consideration as advance. And he is receiving that amount out of the sale consideration as on the date of sale agreement or prior to that by prescribed modes. So if you receive the amount of sale consideration by way of prescribed mode or any part of the sale consideration by way of prescribed mode, then the date of sale agreement, as on that date, whatever stamp duty value is there, that can be taken for section 50C. I have told you. So if the date of sale agreement and date of registration, both the dates are not same, usually we take the stamp duty value as on the date of registration. Getting my point? But we ignore that. And we take the stamp duty value as on the date of sale consideration if the as on the date of sale agreement if the sale consideration or any part thereof is received on or before this date by way of prescribed modes. So this is happening here. On 15th November, you are receiving advance of 150 out of 30 lakh 50,000 of sale consideration by way of prescribed mode. So whatever stamp duty which is there on 15th of November, that stamp duty value only will be considered for section 50C. Getting my point? Now the property was registered. Manish paid the balance entire sum and Mr. Shiva transferred the house. On February 20, 2015. Can I say this is dosa? Is this dosa? So this is idli? No. This is DOR, date of registration. That is date of sale agreement. This is date of registration. Both the dates are not same. And now what is happening? The valuation as per stamp duty authority of such house on 15 November was 39 lakhs and on 28 February it was 41. Tell me which one to take. I will take this 39 lakhs and I will ignore this 41 lakhs. So now stamp duty value is higher than the sale consideration. Check. By how much amount? 8,50,000. Difference between the stamp duty value and the sale consideration is 8,50,000, which is more than 10% of sale consideration. 10% of sale consideration will be 3,05,000 only. So if it is more than 3,05,000 or 3,05,000, then I will have to ignore the sale consideration and this amount will only be taken as my full value of consideration. Yes or no? Now, when did you sell the property? 15th November 2024 or 20th February 2025? The actual sale happens when the property is registered. Okay, so date of registration we always check for the transfer. So what is the date of transfer? 20th of February. As on that date, the property is transferred. Can I say that date is on or after 23rd July? So now whatever cost of acquisition, cost of improvement will be there. Will it be indexed or without indexation? Without indexation. But wait, the period of holding of the property will start from 15th February 1979 till 20th February 2025. This is the period of holding of the immobile property. Is it more than 24 months? Yes, the property is long term. But still, I have the cost also. But still I cannot index that cost. Why, sir? Because the property is transferred on or after 23rd July. 20th February 2025 is on or after 23rd. Even if you by mistakenly take 15th of November, no, that is still after 23rd July only. Yes or no? So will you do any indexation? No. So calculation is very simple now. What are you going to do? Simple, sir. Sir, simple. You will take the full value of consideration. Will you take sale consideration or as per 50C, the amount of stamp duty value will be taken as full value of consideration? Yes or no? So now your presentation will look something like this. Wait, I'll tell you. Wait. Your presentation will look something like this. Give me 1 second. Huh? It's not here. I will solve on my own. I know the solution. Computation of capital gains. Which capital gains? Long term. Okay. So computation of long term capital gains For this, I will make working note number 1. Yes or no? Why long term? I will make working note 1. If you solve the question in this manner, no, you'll get full marks. Don't worry about it. Okay. So, full value of consideration. See, instead of making a separate note, no, you can do the workings here also in your main statement, but it will not look good. Okay, no. So, what we are going to do for full value of consideration, we'll prepare note 2, because note 1 will be for long term or short term. Yes or no? Less what? Transfer expense. Was there any expense on transfer of the property? 1% brokerage. Yes or no? So I will write down 1% brokerage. And my dear friends, brokerage is always on sale consideration. You are not supposed to take it on the amount of FEC. See, our FEC here will be how much? 39 lakhs. For that, I will do a working note. Okay, no? We have already calculated 39, no? We just have to show it in the working note only. Okay. Now, brokerage will be 1% of 30 lakh 50,000. So 30 lakh 50,000 into 1% will be 30,500. Now if I reduce this minus 39 lakhs, I will get 38 lakh 69,500. 38 lakh 69,500. Can I say this is my net consideration? In the exams, no, avoid writing FVC and all. Write the full forms. Okay, no? In the class only we are doing it to save some amount of time. Okay, less. Cost or index cost? Cost of acquisition less cost of improvement. Sir, cost of acquisition, for this also we'll prepare a note. Note 3. And cost of improvement is not there. It will be taken as nil. And it was 9,59,000. No guys. Without indexation I am reducing. Why? I will give the note in the note number 2 only. That why we have not indexed it. Okay. So 9,59,000. If I reduce 29,10,500. Everyone getting this long term gain? This is your LTCG under section 112, because this is not STT paid long term gains. STT paid long term gain of equity shares is covered in 112A. Yes or no? STT paid long term gain of equity shares is covered in 112A. Every other long term capital gain covered under section 112. Okay. So now this is long term capital gain under section 112. From a transfer happening on or after 23rd July. On this you are supposed to pay how much tax? 12.5%. Do you remember? Are you an individual? Yes. Are you a resident? Yes. Are you transferring an immobile property? Yes. So whatever tax you will calculate on this gain at the rate of 12.5%, you will have to compare that tax with the long-term gain with indexation, and that on that you will apply 20%. Now that 20% is better, then pay that 20%, or else pay 12.5% on this. Whichever is more beneficial for you. Yes or no? But to do that, we'll have to again recompute the capital gains. But wait, in my computation of total income, no, whatever capital gain I have to show as a part of my total income will be this much only. I don't have to do the indexation while computing the capital gains. Yes or no? Indexation will be done only for the limited purpose of determining the tax liability. That's it. Getting my point, everyone? Now you will see what is going to happen over here. But wait for some time. Okay. So 29,10,500. This is my long-term capital gain. What I'll do, I'll first make notes. Then in the end, I will calculate the tax liability. Okay, no? So note number 1. Note number 1 is for period of holding, type of capital asset, and nature of capital gains. Done, sir. Now tell me, capital asset is residential house, no? House property. Capital asset is a house property, which is an immobile property, which was acquired in date of acquisition was 15 February 1979. Since this date I am holding it till the date of transfer, that is 20th of February 2015. Sorry, 2015, not 2025. Okay, so can I say this is my period of holding, which is greater than 24 months? Therefore, capital asset is long-term capital asset and LTCG is computed. Done. This was my note number 1. Now coming to note number 2. Note number 2 very important because FVC will be calculated here. Note number 2. Determination of full value of consideration. So I will first write down stamp duty value. Stamp duty value as on DOSA DOR. Date of sale agreement, date of registration. It is 39 lakhs and this is 41 lakhs. So I will ignore this, but I will take this. Why I am taking this? I have to give the reason. I am taking this why I am taking this. Since 1,50,000 out of the sale consideration is paid on or before date of sale agreement. Actual date, if you want to write, you can write the actual date of registration and date of sale agreement also. Yes or no? Please write it down. Don't leave it. Write it down. What was the date of sale agreement? It was 15th of November, no? So write down 15th of November 2024 and date of registration was 20th of February 2025. Okay. So now, before the date of sale agreement, by way of prescribed modes, therefore I will take this. Now see, this amount is greater than sale consideration of 30,50,000 and SDV minus sale consideration. How much? SDV minus sale consideration is 8,50,000, no? Is also greater than 10% of 30,50,000. That is 3,05,000. Now if these two conditions are fulfilled, therefore section 50C would apply, and in this case the full value of consideration is equal to sale consideration of rupees 30 lakh 50,000 will now be ignored and stamp duty value 39 lakhs is treated as full value of consideration. Exactly same manner if you are writing in the exam also, no, still you will get the full marks, not a single mark will be deducted. Don't worry about this. Okay, examiner will go mad seeing these kind of working notes. Okay, now see 39 lakh, how did we derive that 39 lakh? We got it. Now coming to the cost of acquisition. Cost of acquisition we took how much? 9,59,000, no? So for that also we'll have to do a separate working note. Note 2. Is for cost of acquisition. Actual cost as on 15th February 1979, it was 3,59,000. How did I get this? 3,24,000 plus 10% of 3,50,000 or FMV as on 1st April 2001 or SDV as on 1st April 2001. What was the fair market value? 11 lakh 15 or it was 85? 1185, no? Where is 1185? Yes, it was 11 lakh 85,000 and this was 10 lakh 70,000. This or this, whichever is lower. So I will ignore this and I will take this. Okay, is equal to 10 lakh 70,000. Now 359 or 1070, whichever is higher. 10 lakh 70. Why have you done this? House property acquired prior to 1st April 2001. For these type of house properties, what you do? You determine the cost like this. Okay, no? This is your A, this is your B. A or B, whichever is higher. Done, sir? Therefore, cost of acquisition will be 10 lakh 70,000. Now, from this cost of acquisition, no, which was 10 lakh 70, what you'll do? You'll reduce the advance money received and forfeited on first advance money received and forfeited. Tell me the date. April 8 and then May 15, no? April 8 and May 15. This is prior to 1/4/2014 and this is on or after 1/4/2014. Yes or no? How much was that? 1,11,000. This is adjusted under section 51, huh? Under section 51. So 1,11,000 you will write here, and what you will write here? 1,51,000. Okay, you will cut this like this. Why have you done this, sir? Because already taxed as income under the head IFOS under section 56 to 9, specific charges there in previous year 15, 16, and hence not to be adjusted under section 51. I have ignored it. Done, sir? Understanding what is happening in your life? Wait, no. First, let us decide the cost of acquisition, Amma. See, in our main calculation, no, cost of improvement, we have taken nil. I forgot to take that cost of improvement. That I'll do. Don't worry. For that note number, no note is supposed to be done. I'll do that calculation here only. I have forgotten this. Okay, here it is not nil. Cost of improvement is there because first floor is also constructed. No, I forgot to read that. Okay, so this gain will not be this much. The gain will be different. But first of all, we are doing the cost of acquisition right now. We have not come to cost of improvement. Okay, so see, now 10,70,000 minus what? Minus 1,11,000. So the final cost of acquisition will be 9,59,000. Got it, sir? Therefore, cost of acquisition finally after adjusting this is 9,59,000. Now this cost is reduced without indexation since house property transferred on or after 23rd July. Can I say if it is transferred on or after 23rd July 2024? Hence this 959 is taken over here. Okay, no? See, I did the working for this 959. Cost of improvement I forgot. Now I will consider. Okay, so what was the construction? See, I forgot to read this information. In August 2015, Mr. Shiva constructed the first floor by incurring the cost of 3,90,000. So now we have to consider that also. But will we index it or without indexation? Yes, without indexation. So entire 390 I will reduce here only without any indexation. Done, sir? Now can I say 9,38,69,500 minus 9,59,000 minus 3,90,000, 25,20,500. 25,20,500 will be my final capital gain. Sure, sir? Understood? Now pay attention. Now all the notes and everything are done. Now I will be computing the tax liability. Computation of tax liability under section 112 on LTCG. Now see here, no, A, LTCG without indexation. I will write tax on. Tax on LTCG without indexation at 12.5%. Do I have a LTCG without indexation? Do I have that? Yes, I have. That was 25,20,500. 25,20,500 into 12.5%. Into 12.5%. 3,15,063. 25 lakh 20,500 into 12.5% will be 3,15,063. 3,15,063. Everyone getting this tax? So they are telling me to pay this tax. But what I will do? I will tell them that see, I am a resident, individual, house property transferred on or after 23rd July. Hello? But that house property I acquired prior to 23rd July. I will get one option at the time of calculating the tax to pay tax at the rate of 20% on long-term gain with indexation. So now what I will do? I will calculate this tax which I have calculated. Okay. Now I will calculate one more tax. LTCG with indexation at the rate of 20%. So for that, now I would require this LTCG amount with indexation into 20%. So now this tax will come. Done, no? Fill in the blanks. Now whichever is lower of A and B is equal to my tax on LTCG under section 112. But to get this, I will have to first calculate the long-term gain with indexation. I have all the amounts. I just have to index it now and properly, correctly. Okay, no? So what I'll do? Come on. Will I take full value of consideration? I'll directly start from net consideration only. Because till net consideration, everything is same only, no? So I'll directly start LTCG with indexation will be net consideration of how much? How much was the net consideration, guys? 38,69,500. So 38,69,500 minus index cost of acquisition. I will take 9,59,000 now into transfer year CII 363 and I will divide the CII of which year? 2001 to 100. Getting my point? So 959 into 363 divided by 100, I'll get 34,81,170. 34,81,170 and I will reduce index cost of improvement also 3,90,000 into transfer year CII divided by improvement year was 1516, no? 1516. What is the CII? 254. 254. Calculate 3,90,000 into 363 divided by 254. I'll get 557,362. Sir, big problem, sir. What problem, sir? Sir, instead of gain, it is a loss, sir. How much loss? Tell me. 38,69,500 minus 34,81,170 minus 557,362. You get 169,032. 169,032. This is my loss. Long-term capital loss. If I index, no. Hello. If I index, I would not have got. I would not have got any long-term gain. So my long-term gain would have been how much? Nil. Rather, I would have a loss. Yes or no? Then what would have been my long-term gain? Nil. On that 20% would have been nil. Now tell me, which is the most beneficial thing to do? Pay tax 3,15,000 or pay tax 0? Pay tax 0 only. Yes or no? So this will be my final tax liability, everyone. This is color, pink color. Okay. And how did I get this LTCL? I'll write therefore LTCG with indexation is equal to nil, and if it is nil, guys, I will not pay any tax on nil at the rate of 20. Calculate 20% of nil, no, you will find out it is 20, it is nil only. Okay, now pay attention. Do you have a loss? Loss of how much? 169,032. Long term losses will be adjusted against long term gains only, yes or no? But this loss cannot be set off also, this cannot be carried forward also. This is just calculated for the purpose of tax liability. You are not supposed to take any set off or carry forward of this loss. Understanding? So they will ask you whether you will take any set off or carry forward of this loss. No. So please write down a star mark for this loss. No set off or carry forward is allowed for such loss. Did you see how smart our government is? How much smart the government is? They did not allow you to take indexation while computing the capital gains. If they would have allowed you, no. So what you would have done, instead of taking the long-term gain in the computation of total income, you would have taken long-term loss in the computation. So you would have allowed the set off from any other long-term gain. And if other long-term gain was not allowed, no, you were eligible to carry forward that for 8 years. Just imagine. So they said no, in the computation only capital gain without indexation. But when you will calculate the tax liability, no, then calculate the tax at the rate of 20% on what? On LTCG with indexation. But you calculated LTCG, it was a loss here. Meaning that there was no long-term gain with indexation. So there was no 20% tax liability. So no tax liability at 20% or tax liability at 12.5%. Which is better? No tax liability. So I will pay this much tax. So now when I'll go to the government and I'll ask the government that government, what about this loss? What to do about this? Government will say forget it. You are not going to get any benefit of this loss. This loss cannot be set off also. This cannot be carried forward because this is not entering in the computation of your total income. This is calculated just at the time of calculating your tax liability. Got it? This is very important. Very important. See, this type of question they can ask you in the exams. And if this question, I just wish that this question they ask you in the exam. Seriously. You will be very happy to solve this question. Okay. Will be for minimum 8 to 10 marks. This type of question. Just imagine what is there in this question. You can't do all these things. Everything which you know is there. You just should know that what to do and when to do. That's it. And how to present it. And this you will learn by practice. One or two questions will not give you that confidence. You will be able to calculate. But sometimes in the calculation also you will do mistakes. That is okay. Done. Doable. But once you are making the correct calculations and you are not able to present, then you require practice. Practice of writing and solving the questions. Getting my point? Okay. So this was your question number 7. We have completed it. Now see, we are into section 47 only. And we did few things before section 47. So gradually, slowly, gradually we are moving ahead and we are seeing that whatever we are learning now, if that is there in the question, we are able to solve it or not. Okay. So now we are moving ahead in section number 47 only. In section number 47, first transaction I told you, conversion of bonds into shares, done. Second, conversion of preference into equity, done. Even if you don't have questions in the ICI study mat, don't worry. The examples which I have created, those are questions only. Okay. I have not copied questions from anywhere. Those examples are framed by me. And you will get the questions exactly in that same manner in which the examples are framed. So on every concept, minimum one question we have solved. Okay. Now, the third transaction was on partition of HUF. If the HUF is transferring capital asset to the member, that transfer is exempt in the hands of HUF. Forget about HUF now. Now talk about member. Member has acquired the asset on partition of HUF. Partition of HUF is a mode specified under section 49(1), meaning that the member has acquired the property by way of a mode specified under section 49(1). So whenever the member will transfer this property in the future, what the member will do? Will calculate the capital gains of this property, of this capital asset. But to calculate that capital gain, what cost he will reduce? Cost to previous owner will be deemed to be cost in the hands of member. Any cost of improvement incurred by the previous owner, incurred by the HUF, will also be taken as cost in the hands of member. Any period of holding of the previous owner shall also be included in the period of holding of the member to determine whether the asset is long term or short term. Yes or no? But wait. Indexation he will take only for his period of holding. When it comes to indexing the cost. When it comes to indexing the cost of acquisition, not cost of improvement. Cost of improvement will be indexed with effect from the year in which it was incurred. But cost of acquisition he will index with effect from the previous year in which he acquired the capital asset for the first time as per the legal requirement. However, the decision of Manjula Bain, Bombay High Court judgment, yes or no, if that decision would have been applied, then he would have taken the indexation from the year in which the previous owner, meaning HF, acquired the capital asset for the first time. And indexation and everything he will do only if he has transferred the capital asset on before 23rd July. Talking about indexation will not come only if he has transferred the capital asset on or after 23rd July 2024. Yes or no, sir? Sure, sir. Now we will go to the other transfer. This one. See, the second transaction which we are doing is transfer of any asset. It is not second transaction, in fact it is fourth transaction under section 47. If there is any capital asset which is transferred by way of gift, will, inheritance or irrevocable trust. Irrevocable trust means what? A trust is created. On the name of that trust, the property is transferred, and whoever is the beneficiary of that trust, till the time that beneficiary does not die, the property remains with that trust. The property will not come back. Okay. Entire benefit of the property or the property will be used for the benefit of that person for whose benefit the trust is created. Yes or no? So I will not take back that property till the time the beneficiary is alive. Getting my point? So that trust where the property is transferred in such a way is known as irrevocable trust. Irrevocable means I will not revoke the transfer. Permanently the property belongs to the trust now till the time the beneficiary is alive. So if I transfer the property in such ways, in all these cases, there is no consideration flowing to me. I cannot say that I have gifted the asset to someone and I am getting a consideration. Bloody, if I am getting the consideration, then it is not a gift. Gift is something which is without consideration. Yes or no? If I transfer my property to my son under a will, is he going to pay me any consideration for that? No. If I die after my death, my son or my family members will inherit my property. Are they going to pay me any consideration for that? No. Even if I transfer the property to any trust, and that transfer is an irrevocable transfer, meaning that I'm not going to get anything from the trust. I've just put the property on the name of the trust. That's it. In all these transactions, the transferor never gets any consideration in return. Yes or no? I don't get any money. So what I have done, for example, I am gifting you one asset. So you are a transferee, I am a transferor. Gifting you means, have I taken any consideration from you? No, no consideration is taken. So even if there is some gain in the appreciation in the value of that property for the period for which I am holding the property, till the time I am not gifting it, whatever appreciation has happened in my hands, I will not realize that appreciation. Why? Because I am not getting any consideration. If there is no consideration, then how the capital gain should be taxed? Just because the ownership is getting changed, just because the possession of the property is given. Hello? So there cannot be any capital gain in real terms realized by the transferor. So this transfer should be exempt. And the reason why this transfer was getting exempted, the reason was very simple. See, out of love and affection, you will give your property to someone, no? Out of love and affection, see, there is always a motive of, showing your love to someone by giving that property. By way of what? Will, by way of inheritance, by way of gift, or even transferred by way of irrevocable trust also. Who can show this love? Come on, tell me. Only those people, only individuals and HUFs can show this love. If I am gifting the asset to someone, I can say that out of love, I have gifted the property. Hello? If I have given the property under a will to my son, out of love only for my son, I am giving that property to my son. If I don't love my son, I'll not give my property to him under a will. I'll tell him, do whatever you want. I'm not going to give you my property. There are many instances also, no, where the father is very angry with the son. He'll take out his son from the will. His name will be taken out. He is not going to get any property, any assets belonging to the father. Why? Because father is angry on him. He does not love back the father. Father does not love him. So the property he will not get. See, in will also, there is what? Some love and affection. So usually when the government, when the lawmakers were making this law, when they made section 47, their intention was that under all these transactions, some love or affection is hidden, out of love, out of affection, if the property will be given to some person, and as a result of that, the transferor is not going to get any consideration, then why to bloody charge this amount? Why to bloody, charge the appreciation in the hands of transferor? Leave it, forget it, exempt transfer. This was the main intention. But this provision used to get abused. Because earlier, see. Can you see one thing? Prior to amendment, any person giving the gift, any person giving any asset to any person. Because under section 47, these two words were missing. Individual or HUF. This transfer made by individual or HUF can be exempted. These words were missing. So what everyone used to do, even a company is there, if I am a company and I have given you some asset and in return I have taken the consideration also, but I don't want to show that consideration as my taxable income. What I used to do, I used to tell, transfer by way of gift, exempt transfer, no capital gain. Because under section 47, it is nowhere written that the gift, will, inheritance, irrevocable transfer, by way of these modes, if the property will be transferred by specific person, then only it will be exempt. It can be transferred by anyone. Yes or no? So if anyone, any person transferring by way of these modes, the transfer used to get exempt. So this provision was abused by many assessees. They used to take their income by way of these transactions. Okay. And the person who is, this person is receiving income also, and this person is not paying tax also. Not paying tax also. Getting my point? So what used to happen? This provision, which was made with an intention that out of love and affection, if the property is transferred, hence the gain should not be taxed in the hands of transferor, this is getting abused. Now enough is enough. Enough is enough. Who can show the love? Who can show the affection by transferring the property by way of these modes? Only these people. Individuals and HFs. Only the individuals and HFs can show the love, no? Hence what they did, they amended this clause under section 47. Now they said that with effect from this previous year onwards, previous year 24, 25 onwards, beginning only, yes or no? If you transfer your asset to any person by way of gift, will, inheritance, irrevocable trust, it will be treated as your exempt transfer provided you are an individual or HF. Any other person transferring asset and saying that, see, I have given gift, the transfer should be exempt. Now they are not going to get the benefit of this exemption. Getting my point? So only the individuals and HFs who have transferred their capital asset by way of gift, will, inheritance, irrevocable trust to any person. Now you can transfer to any person, yes or no? But the transferor should be an individual or HF. Only then for this type of transferor, showing their love and affection will not be charged under the head capital gain. Transfer will be exempt. Did you understand this much? Let us take one example. Okay? Let us take one example. See, Mr. A is there. He acquired one asset, one capital asset on 9 September 2009. See, last time we had 11th November 2011. This time it is 9 September 2009. Okay. So it is, easier for us to remember the things. That is why. So in the previous year 9-10, Mr. A acquired one capital asset for 1 lakh. Now the asset which he acquired for 1 lakh, on that asset he did some improvements. Improvements in the year 2012-13 amounting to 1 lakh. Again 1 lakh rupees improvement also done. Now the value of that asset on 11th December 2013, 11 December 2013, the value of this asset was 4 lakh 50. Till that time Mr. A was holding the asset. Because on 11 December what is happening? He is giving this asset for gift or will or inheritance or irrevocable trust. He is giving this asset away to Mr. B. Possible? So the asset is gifted to Mr. B. Now tell me, when the asset is gifted, 11th December 2013, that time this amendment was not there, huh? That time this amendment was not there. At that time even the company would have given that transfer would have been exempt. So when the transfer is happening, transfer is happening in 13-14, that time whoever gives to whoever, the transfer used to be exempt. But from now onwards, see, if Mr. A will transfer now in 24-25, then it will be exempt. But instead of Mr. A, now it will be A Limited transferring the asset by way of gift on or after 1st April 2024. Now that transfer will not be exempt for A Limited. Earlier it used to be. Meaning that up to previous year 23-24, what did I say? Till last year, up to previous year 23-24, transfer of any capital asset by way of gift, will, inheritance or irrevocable trust by any person was treated as exempt transfer. So see, who has transferred? Individual has transferred. Individual, even if right now he will transfer, the transfer will be exempt. Yes or no? Yes, right now also he will transfer, the transfer will be exempt. Earlier he transferred, so that time also the transfer was exempt. Now can you see the asset which was 1 lakh, which was worth 1 lakh, he acquired that asset for 1 lakh. As on the date of gift, the value of that asset was 4 lakh 50. Can I say there is an appreciation in the value by 3 lakh 50,000? Right now, forget about this cost of improvement. Yes or no? Because we have to consider the cost of improvement also. Now forget about that cost of improvement. Right now, how much is the appreciation in the value? 3 lakh 50. That appreciation no is not realized by Mr. A. See, for his period of holding, the value of the asset increased by 3 lakh 50. But is he receiving that 1 lakh rupees is he receiving that 3 lakh 50 appreciation in his hands? No. So why should he be taxed? So exempt this capital gains in the hands of Mr. A. Section 47 over. Hello sir. Section 47 over. Out of love and affection he is transferring. And out of love and affection, whatever asset he has transferred, for that he is not getting any consideration. Meaning whatever appreciation has happened so far, he has not realized. Why to charge tax on that? Just because the asset is, ownership of the asset is getting transferred, just because the possession of the asset is going away, he should not be charged for this 3 lakh 50 right now. That does not mean that we don't want to charge tax on this 3 lakh 50. We don't want to charge tax in 13-14 from Mr. A because he is not the person who will realize this gain of 350. Who is going to realize this gain? Yes, now Mr. B has this asset. Whenever Mr. B will transfer that asset, no, B will realize the gain for his period of holding also, and B will only realize this gain. So who should pay tax on this gain? And on the gain happening in his period, on that gain also he should pay tax. So what is happening in 13-14? B is receiving the asset by way of gift, will, inheritance, irrevocable trust. All these modes are specified in 49.1. So modes which are given in section 49.1, under those modes, gift, will, inheritance is also written. So now if you are an assessee, what did I say? If you are an assessee, you have acquired the asset by way of any of the modes specified under section 49.1. 49.1, what are the modes specified? On partition, you have acquired. Gift, will, inheritance, all these modes are prescribed or specified in section 49.1. So is Mr. B acquiring the capital asset by way of a mode specified under section 49.1? Yes. So whenever Mr. B is going to transfer this asset, cost of acquisition to calculate his capital gain will be the cost to previous owner. Wherever you are going to apply 49.1, you have to apply the same provision. Last time also you applied 49.1 only, no? Hello? In the hands of member. Now that 49.1 you will apply in the hands of Mr. B. Instead of member, now it is Mr. B. Instead of HUF, now it is Mr. A. Every damn single thing remains same. Mr. B will calculate capital gain. Yes. Why? Because Mr. B is transferring on 12th July. See, I have deliberately kept that date 12th July. Because I want you all to do indexation also. If I would have taken that date on or after 23rd July, what is the cost? 1 lakh. Will be cost in the hands of Mr. B. So whenever B will transfer, what cost he will reduce? 1 lakh without indexation. And any cost of improvement incurred by the previous owner will also be treated as cost in the hands of Mr. B. And B's cost of improvement also he will reduce. Because some cost of improvement is incurred by Mr. B also, no? So now tell me, when Mr. B is transferring? 24-25. So in 24-25, the capital gain will be calculated for Mr. B. How much? Full value of consideration. Come on. 10 lakh. Minus transfer expense? Nothing. Nil. Net consideration is 10 lakh. What will be the cost which Mr. B will take? If B is taking this amount as his cost, saying that the property came to me at that time, the value of the property was 450 only. And from that day I am holding the property, and in my hands the appreciation is only 5,50,000. So I will pay tax only on 550. Bloody that 550 you are realizing. On that you are supposed to pay tax. But that gain which was for the period of holding of your previous owner, that gain also you are realizing, no? Which we have exempted him by exempting transfer in his hands. Yes or no? So you will have to pay tax on the gain happening in your period of holding also. You will have to pay tax on the gain happening in the period of holding of the previous owner also. And for that, what cost will be taken? 450? No. Cost to previous owner will be treated as your cost to calculate your capital gain. Come on. Now, if out of 10 lakh, 1 lakh will be reduced, 9 lakh will be the capital gain. Meaning that this 350 gain will also be covered and this 550 gain will also be covered. Yes or no? So cost, you know, cost in the hands of the assessee, Mr. B, will be nothing but cost to previous owner, because Mr. B acquired the capital asset by way of a mode specified under section 49(1), that is gift, will, inheritance, irrevocable trust, etc. Now, any cost of improvement incurred by the previous owner will also be treated as your cost, because 49(1) is getting applied. Yes or no? Is your period gain taxable for you, or the earlier period gain also taxable for you? Earlier period gain is also taxable, no? So why are you taking your period of holding? Include the period of holding of the previous owner also in your period of holding. Now, will you check the period of holding from 13-14 to 24-25? No. You are supposed to check the period of holding of the capital asset starting from 9-10 to 24-25. This will be the period of holding. Now, based on this period of holding, if the asset is short term, you know the cost of acquisition and cost of improvement reduced without indexation. Hello? But if based on this period of holding, if you determine that the asset is long term, in our case it is long term only, please check. More than 12 months, more than 24 months, more than 36 months. Asset is long term. Then indexation will happen. Indexation for cost of acquisition, cost of improvement only if you have transferred the asset prior to 23rd July. But remember, cost of improvement will be indexed with effect from the year in which it is incurred till the year of transfer. Cost of improvement will be indexed with effect from the year in which it is incurred till the year of transfer. Yes or no? But cost of acquisition will be indexed only for your period of holding. The date on which, the year in which you started holding the capital asset for the first time. From that year onwards, you are going to get the indexation. Yes or no? But if the decision of the Honorable Bombay High Court in the case of Manjula Ben Shah is applied, then it will be assumed as if you have started holding the capital asset for the first time with effect from the previous year in which previous owner held it for the first time. Then you are going to get the indexation for the entire period. But that is not going to come in your main solution. It is going to come in your notes. So tell me, in the previous year 13-14, if they tell you to calculate capital gains in 13-14, what will be your answer? In the previous year 13-14, assessment year 14-15, transfer made by Mr. A to Mr. B by way of gift, will, inheritance or irrevocable trust is exempt transfer under section 47. Therefore, no capital gain will be computed and taxed in the hands of Mr. A. Previous year 13-14 over. Now they are telling you to calculate the capital gains for 24-25. Now you will calculate the capital gains in 24-25 in the hands of the transferor. And who is the transferor now? Who is the assessee? Mr. B. Now for Mr. B, you are going to calculate the capital gains. What will be your full value of consideration? Come on, tell me. 10 lakhs. Transfer expense nil. Net consideration 10 lakhs. What cost you will take? For Mr. B, what will be the cost? Cost to the previous owner. Yes or no? Will be taken as cost in the hands of Mr. B. Index it. Why index, sir? Because if you have to take the period of holding, don't take your period of holding. Take the period of holding of the previous owner also. Include it in your period of holding. Yes or no? So what you will do now? Index the cost, because that period of holding starting from 9-10 to 24-25, that period of holding is more than 24, more than 12, more than 36 months. Yes or no? And asset is also transferred prior to 23rd July. So indexation will happen. So will you take 1 lakh? Yes. Multiplied by transfer year CII. Multiplied by transfer year CII. Divided by acquisition year CII. You will take for this year. But if you apply Manjula Ben judgment, then acquisition year CII for this year. Yes or no? So what you will do? Come on, fast. 1 lakh will be your cost into transfer year CII 363 divided by acquisition year is 1314. What is the CII of 1314? Tell me. 220. So divide by 220. You will get 1,65,000. Everyone getting this? So you will reduce 1,65,000. Please check. That same thing which we have done. Okay? Sure? Same thing we have done? Perfect? Now wait. Do you have cost of improvement? Cost of improvement incurred by you also and cost of improvement incurred by the previous owner also. Cost of improvement incurred by the previous owner will also be taken as your cost. Yes or no? And it will also be indexed. So what you will do? You will take 1 lakh into CII of transfer year 363 divided by CII of 1213. So what is the CII of 1213? 200. So what you will do, sir? You will take 1 lakh into 363 divided by 200. You are going to get 1,81,500. All of you are getting it? Please check. 1,81,500. Are you going to get the deduction for your cost of improvement? Yes, you are going to get the deduction for your cost of improvement also. And that will also be indexed. So what you will do? You will take 1,25,000 cost of improvement incurred by you multiplied by 363 transfer year CI divided by improvement year CI is 280, no? Improvement was done in 1819. So CI of 1819 is 280. So you will get 1,62,054. 162,054. Yes or no? 162,054. This is index cost of improvement. This is index cost of improvement. Total cost of improvement is this. Index cost of improvement total. Yes or no? So out of your net consideration, index cost of acquisition and index cost of improvement, you will reduce. You will get the capital gain. This is your long-term capital gain. Taxable under section. Taxable under section 112. Done at 20%. Why? Because the transfer take place prior to 23rd July. So any transfer which takes place prior to 23rd July, and from that if you are calculating capital gain, you will do the indexation also, and indexed long-term gain will be taxable always at 20%. Hello sir. And why this long-term gain is there? Why this collaborative? Because you are taking the indexation, you are taking the period of holding starting from the date on which it was acquired by Mr. A till the date on which you transfer it. Total period of holding you are checking. Getting my point? Hence the asset is long term, hence the resulting gain is long term, hence you have done the indexations also. Got it, sir? Easy? It's made easy. Say thank you. Okay, so entire thing which is given here, no? See, now, wait. If you follow Manjula Ben judgment, then this will remain same, this will remain same, this will remain same, this will remain same, only this will change. Because this will change. Now the CII for 910 you will divide. What was the CII for 910? Come on, tell me. It is 148. So you will take 1 lakh into 363 divided by 148. It will be 245, 270. It will be, instead of this, you will write 245, 270. This will be your index cost of acquisition. If you follow Manjula Ben judgment, if you index it from beginning, yes or no? But that you are going to write down in the note. So do one thing. From your 10 lakh, now reduce 242, 270 and 343, 554. How much you are getting? Tell me. 754, 730. No, how come? No. Reduce the index cost also, no? Index cost of improvement also. Out of 10 lakh, index cost of acquisition and index cost of improvement both will be reduced, no? So it is 4,111,76. Instead of this, now your capital gain will be 4,111,76. Getting it? That is the same thing which I have done. See, 4,111,76 and your index cost will be this much. Got it, sir? Sure, everyone? Paka? Okay. Now, before I tell you the other part of this section, I would like to test your knowledge. I would like to test your knowledge, not the ICI. Tell me, do you remember salaries head? Under the salaries head, what we did? First of all, I'll ask you, okay? See, there is one employer. Employer is giving what? Shares or securities under ESOP. Or he might be giving you sweat equity shares. Yes or no? Now, these are given to whom? These are given to an employee. Okay. Now, this employee is there. This employee is there. Very happy. Why he is happy? Akshaya, why the employee is happy? Tell me. Because he is getting these shares, securities under ESOP, sweat equity shares he is getting from the company free of cost, or at a very concessional price he will get it. So either he will get it free of cost or at concessional rates. Yes or no? So he will be very happy. See, it looks from his face also. Will make him happy. Very happy, sir. Very happy. Very happy. Big happiness. Okay. Now he is happy. Tell me why he is happy. He is getting the shares free or concessional rate. Because of this, what is happening? Some personal benefit is happening. And this personal benefit which is happening to him is nothing but his perquisite under section 17 subsection 2 clause 6 in his hands. And this will be taxable also. This will be taxable also under the head income from salary. How much value will be taxable? Do you know how to calculate it? What will be the taxable value of this perquisite, TVOP? Did you calculate this under the salary head? We used to take the fair market value of these shares, the shares which he is getting. So the fair market value of these shares as on DOEOO, I told you this, DOEOO, date of exercise of option. Meaning that he got the option to buy these shares. He got the option to acquire these shares. Now, whenever he will exercise, he will go and tell the company that company, I want to exercise this option today and I want to take these shares from you. So company is going to allot. But he will have to first go and exercise this option. Yes or no? So the date on which he will go and exercise this option, on that day, whatever is the fair market value, that much benefit happening to him. But out of that, some amount will be recovered by the company, no? If free of cost given, then this entire amount is his benefit, yes or no? But if some amount is charged, but amount will be very small amount, yes or no? Will be very less as compared to the fair market value. So for example, whatever recovery is made, recovery from employee, we also call it exercise price. If you remember, today I am coming and exercising my option, take this money. So this is my exercise price. You only fix that price. That whatever may be the value of these shares in the market, you will come and we will give you 1000 shares at a predetermined price of rupees, for example, of rupees 500. You just give 500 rupees per share and take the shares of the company. Go. Poda. Hello. You are exercising that option. That time how much money you are giving? 500 per share you are giving, no? So you are spending 500 out of your pocket and getting the shares whose value will be more than 500. Maybe the value will be 1200 as on that day. So if the fair market value happened to be 1200, against that, whenever you are going and exercising the option, at that time you are paying 500, that is your exercise price, nothing but the amount recovered from you, nothing but your actual cost of the shares. Now, if someone will ask you that for how much you acquired the shares, what you will say? I acquired them for 500. 500 only is your actual cost, no? So, 700 will be your benefit per share multiplied by the number of shares for which you are exercising the option. Yes or no? So, 700 per share will be your taxable value of perquisite, and this will be taxable in the year in which the option is exercised. Yes or no? It is not taxable in the year in which the option is exercised. This benefit will happen to you when the shares are allotted. No. So this value will be taxable. This 700 value will be on the basis of fair market value as on the date of exercise of option. But the taxability does not depend on the date of exercise of option. Taxability of this amount depends on the date of allotment. I told you. Whenever the company will allot these shares to you, that time this 700 will be taxable for you. What if you are exercising the option in this year and allotment is also happening in this year? No problem. Tax 700 in this year. Hello, sir. What if you are exercising the option in this year on 20th March and the shares are allotted on 10th of April next year? Value you will determine right now, 700. Based on the date of exercise of option, whatever is the fair market value as on that day. But that 700 will not be taxed in this year. It will be taxed in the next year because the shares are allotted in the next year. Yes or no? This entire thing I have explained properly, guys. Will you remember everything till examination? I am worried. I feel as if I should cry, but I will not. I am strong. I will not cry. I know that you all will not let me down in the exams. You will remember. See, if I'm speaking, the things are clicking in your mind. No, yeah, something like this sir had said. Or it is new only. Nothing new, huh? You remember, no? Try to recall something. Perfect? Now tell me. 700 taxed in your hands. Under the head, salary. Example, date of exercise of option I'll write. Okay, no? Date of exercise of option. 4th of May 2020. 4th of May 2024. I exercised the option. So fair market value as on the date of exercise of option was 1200, which will be used to value the perquisite. Yes or no? Now, for example, these shares were allotted. Allotment of these shares happened on 12th of June 2024. When the shares are allotted, from that date only you will start holding the shares. And on that day only you can say, no, this benefit occurred to you. So when this benefit occurred? In this year only. When you exercise the option? This year only. Yes or no? So when this benefit will be taxable? This year. Why? Because the option is exercised? No. Because the shares are allotted in this year. So the benefit of 700 will be taxable as your income from salary. As your income from salary, this is a perquisite for you. 700 will be taxable under the head salary. Okay? Now tell me, this 700 is already taxed. Now do you have these shares? Do you have these shares? These are your capital asset now. Now later on, if you sell these shares, for example, these same shares you are selling. These shares are sold. Sold, for example, they are sold on 1st of December 2024. You sold them. And sold for how much? You know, sold for how much? Sold for 1250 rupees. How much you sold them for? 1250. Can I say you are selling your capital asset now, which was shares, sweat equity shares, shares or securities under ESOP, or sweat equity shares, which was your capital asset, which you did not buy from the open market, you bought it from your employer at a very concessional price. Yes or no? And for that, benefit is also calculated and charged under the head salary in the form of perquisite. Now these shares, whenever you are having, these are your capital asset. Did you acquire normally? No, you acquired them as sweat equity shares. You acquired them as ESOP shares. Yes or no? You did not acquire them from open market normally. Now these shares, which are your capital asset only, now you are selling them for 1250. At the time of sale, will you calculate capital gains? At the time of selling these shares, will you calculate capital gains? What will be your full value of consideration? 1250. Minus transfer expense, nothing. What will be net consideration? 1250. Yes or no? What cost you will take? Be very careful. Be very careful. Usually, the assets which I acquire on or after 1st April 2001, actual cost of that asset is taken as my cost of acquisition. So did I acquire the asset on or after 1st April 2001? Yes. So what was my actual cost? I paid 500 to the company, no? From my pocket. So my actual cost is what? 500. So usually the actual cost of the asset is treated as cost of acquisition. So I will reduce 500 from here. Example. Okay. What will be my gain? 750. This will be my capital gain. If I do it, what will happen, That 700 which already got taxed under the head salary as my perquisite will again be taxed in the form of capital gains. Just imagine, apply some common sense. You gave 500, you spent 500 to get the shares, and in return how much you are getting? 1250. So how much is the total gain? Total gain is 750, no? Out of 750, if 700 is already taxed under the head salary as your perquisite, how much should be taxed now? 750. If 750 you are charging, that means that 700 is again getting charged. Now out of total 750, 700 is already taxed under the head salary as your perquisite. Now only 50 should be charged. So to charge 50 as capital gain, you should not take the actual cost as cost of acquisition. There is one section 49 2AA which says that the fair market value which you took to calculate the perquisite, fair market value as on the date of exercise of option, take that same fair market value as the cost of these shares while calculating their capital gains. So what was the fair market value, guys? 1200, no? Reduce 1200. So the gain will be taxable only 50. Now that 1200, no? That 1200 takes care of 500 spent by you and also the 700 which already got taxed. So 700 plus 500, 1200 you reduce, only the gain over and about 1200 will now be taxed. Getting my point? Everyone, from which date you will start the period of holding? Now tell me, come on. From which date you will start the period of holding? The date on which the company allotted the shares. When the allotment happened? 12th of June 2024. So from this date, the period of holding will start. Hello sir, the date on which the shares were allotted to you by the company, by the employer, from that date only you start holding the shares, no? So period of holding will start from that date. Till what date? The date on which you are selling them. Based on this period of holding, if you say that the shares are short term, then you already have the cost of acquisition. How much? 1200 as per 49 2AA. What is your cost? 1200. Reduce without indexation. Hello. But if based on this period of holding, if the shares are long term, held for more than 24 months, and if listed then held for more than 12 months, then do one thing. Index the cost. But cost will be 1200 only. You are supposed to index. And indexation will happen only if the shares are transferred prior to 23rd July. Otherwise, even if they are long term, indexation will not happen. If you are transferred on or after 23rd July. Are you seeing everywhere 23rd July is playing a very important role? Even if you don't remember your birthday, no. You have to remember 23rd July. Okay. Now, tell me, did you understand entire thing? Should I create a small question in front of you? Okay, wait. See, Mr. Ram was allotted 1000 equity shares as 1000 shares as sweat equity shares, 1000 sweat equity shares from by his employer on 19th of April 2024. 19th April 2024, yes or no? He paid rupees 400 per share to the company, meaning employer, to acquire these shares when he exercised the option on 2nd April 2024. Fair market value of such shares as on 2nd April 2024 was rupees 1000 per share, and fair market value and as on 19th April 2024 it was rupees 950 per share. Exact same question can come in the exam in the form of MCQ. You won't believe, I have not seen this question anywhere. This is coming from inside. The questions is being framed live in front of you. Okay, if somebody tells you no, that sir is solving question from different, no, sir is solving question from his own mind. He's creating these type of questions so that you all get the proper idea that what type of questions they can ask you in the exams. I have seen thousands of papers. Okay, now pay attention. What they have given, tell me. The shares are allotted in this year and the option is also exercised in this year, and two fair market values are given. One is of the date of allotment and one is of the date of exercise of option. Okay, now these shares, if these shares, not if, these shares, only these shares are later on sold by Ram on 9/9/2024 for rupees 1500 per share. Okay, now here there can be a twist also. What twist? You are allotted 1000, so these shares are sold means 1000 are sold. They can tell you out of those shares 600 are sold, so the calculation will be made only for 600. Yes or no? Be very careful. But right now let us not complicate that much. 1000 shares you got, 1000 you are selling. Okay, for 1500 per share, compute the tax effects and briefly comment. 6 marks question. Or there will be a case study for MCQs. What will you do here? Wait. Please pay attention here. Read the last line. Read the last line. Read the last line. Compute the... They're not telling you to compute capital gains. They're telling you to compute the tax effects. Meaning what? You will be computing the perquisite value also, and tax effect should be given in salary. And you will be calculating the capital gain, and tax effect will be given under the head capital gains. Getting my point? So how much will be perquisite? Come on, tell me. Look at this and tell me how much. Fair market value as on the date of exercise of option. I will blindly go and check that. 1000 rupees. Yes or no? Minus the exercise price. How much? 400. 1000 minus 400, 600 rupees. Multiplied by 1000 shares. You exercised the option of 1000 shares. 1000 shares were allotted. Okay, no? So 1000 shares multiplied by 600. 6 lakh rupees is the taxable value of perquisite. 17 subsection 2 clause 6. This value will be taxable in the previous year 24-25 itself under the head salary. Why? Because these shares are allotted on 19th April, meaning this year only. Deliberately the fair market value as on the date of allotment is given so that you get confused and you take this 950. For your perquisite valuation, 950, the fair market value as on the date of allotment should not be taken. Only the fair market value as on the date of exercise of option, which was 2nd of April. Yes or no? Only that should be taken. Getting my point? Now tell me. 6 lakh is your taxable perquisite. Meaning that 600 per share got taxed in your hands under the head salary. Now these shares you are selling in future. Will you calculate capital gains? What will be the capital gain? Come on, tell me. Selling price 1500 minus transfer expense. Nothing. Net consideration will be 1500 minus cost of acquisition. What cost you will take? For these type of shares which you have acquired under ESOP, their cost will be as per 49(2)AA. Hello, always. No other cost, only 49(2)AA. And 49(2)AA says the fair market value as on the date of exercise of option which was considered to value the perquisite. That fair market value will be deemed to be the cost of these shares. And what was that fair market value? That was 1000 rupees. That only you considered to value the perquisite, no? So 1500 was the net consideration minus 1000. You will get 500 rupees short-term capital gain. Why short-term capital gain, sir? Because the shares were allotted to you. Shares were allotted to you. On what date? 19th April 2021. So this is the date on which you start holding the shares. And these shares were sold by you on 9th of September. If nothing is mentioned, these shares are unlisted. So for these unlisted shares, can you see the period of holding? The period of holding will start from this date. It will end on this date. This is less than 24 months. Hence the cost will be indexed. No, cost will be reduced without. And cost will be 49(2)AA only. Getting my point? And remember, you bought it for 400 and you sold it for 1500. 1100 gain. Out of that 600 is already taxed under the head salary. So how much should be taxed under the head capital gains? 500 only. So your capital gain should be 500. And that is short term gain. Did you compute the effects and briefly comment? Yes. So now I will dictate the answer. Okay? Write down. Previous year 24-25 dash assessment year 25-26. Next line. Computation of taxable value of perquisite TVOP under section 17(2)(6). Why are you calculating and charging in this year? Because the shares are allotted in this year. So this will be your income for the current year which you are going to show under the head salary. Yes or no? So computation of taxable value of perquisite TVOP under section 17 subsection 2 clause 6. Underline. Next line, FMV as on DOEOO. FMV as on DOEOO. In the bracket write down 2nd April 2024. Please specify that date. And in the amount column write down 1000. Okay. Next line, less amount recovered from RAM. Amount recovered from RAM. In the bracket write down exercise price per share. And in the amount column write down 400 per share, 400. Do the plus minus and you will get the balance of 600. Against that 600 write down TVOP. And the next line you will multiply it by 1000 shares. Multiply, in the first line it is 600 per share. In the next line into 1000 shares. So your final value will be 6 lakh rupees. Against that 6 lakh rupees write down taxable under the head salary. That's it. This is the tax effect which you have computed and briefly you are commenting also. Yes or no? Next one. Next line you are writing. The above shares were sold by Ram. Sold. Underline the word sold. What is the importance? You will come to know within some time. Okay. I was under section 47 and from 47 see where I have come. First this base will be created, only then you will understand that what is going to happen over there. Yes or no? So I am telling you to underline the word sold. Okay. The above shares, these shares were sold by Mr. Ram on 9/9/24 as STCA, short term capital asset. In the bracket write down POH is equal to. Now if you start counting POH from 2nd April you are gone. You have to start counting from 19th April. Yes or no? So POH is equal to 19th April 24 to 9 September 24, which is less than 24 months, bracket close. So the above shares are sold by Mr. Ram on 9 September 24 as short-term capital asset. Why short-term capital asset? In the bracket you have written the period of holding also. Hence, STCG would be computed and taxed. STCG would be computed and taxed in the previous year 24-25. In the previous year 24-25. Okay. In the following manner. Write down FVC. See, wait. Pay attention. If I want to make this a little bit more difficult, no. I have not deliberately done it, but I am telling you, this can also happen in the exam. On 9th of September 2024, the fair market value of these shares was 1700 per share. That information is also given. Example. That is not given in the question, but what if they are giving you the fair market value of these shares as on 9th September 24. As on the date of sale, the fair market value is also given 1700 per share. Why they have given it, you know? They want you to apply 50CA. The fair market value of shares other than quoted shares is more than the sale consideration. Sale consideration will be ignored. Fair market value will be taken as full value of consideration. Then the full value of consideration which you are taking right now as selling price, no, 1500, you would have ignored that. Hello sir, understanding? Please remember these small things, huh? Okay. Now tell me, FVC you have written? In the bracket write down sale proceeds. So you are taking the sale proceeds only as full value of consideration. Okay. 1500. Amount column 1500. Less transfer expense dash. Net consideration 1500. Done, sir? Less COA. In the bracket you will write down COA. In the bracket you will write down FMV as on the date of exercise of option. FMV as on DOEO considered to value perquisite under section 17(2)(6) bracket close. That amount you are going to reduce as cost. Yes or no? So now reduce. How much you are going to get? You are going to get reduce 1000. You are going to get 500. But if I would have given you the fair market value as on the date of sale, you would have taken that fair market value 1700 under 50 CA. Then your capital gain would have been how much? 700 and not 500 only. Getting my point? And against that write down short term capital gain. 500 will be your short term capital gain. Okay, now? So these are the tax effects. If this type of question will come in the exam, these type will be minimum for 6 marks or MCQ can also come. Now wait. Now these shares which you are having, no? Earlier till previous year 23-24, if shares or securities received under ESOP or sweat equity shares are transferred by way of, don't write, no need to write, wait. This is general knowledge which I am giving you. This is not applicable anywhere now. Till previous year 23-24, till last year I am talking. So section 47 clause 3. What clause 3 said? That if you are any person transferring any capital asset to any person by way of gift, will, inheritance, irrevocable trust, will be exempt transfer. That was 47 clause 3. In clause 3, in the main provision, they made one amendment. With effect from 24-25 onwards, this transfer will be exempt only if made by individual or HUF. 47.3 main provision amended. Now only the individual and HUF transferring by way of gift, will, inheritance will be exempt transfer. Now till last year, transfer by any person was exempt. Yes or no? Till last year, what used to happen? Till last year, they were saying that transfer of any capital asset by way of gift, will, inheritance, etc. will be exempt. Other than these shares. If these shares which you received under ESOP, if these shares which you received as sweat equity shares, if you have transferred them by way of gift or irrevocable trust, then that transfer was not exempt under section 47. Then capital gain used to get calculated over there. This was a proviso to the main clause. Main clause saying all the assets, gift, will, inheritance, irrevocable trust, transfer is exempt except for the transfer of these shares by way of gift or irrevocable trust. Meaning that till last year, no, their gift or irrevocable trust was not an exempt transfer. But if they were transferred by way of will or inheritance, that was still covered by section 47. It was still an exempt transfer. So here the capital gain was not calculated and here the capital gain was calculated because that was not treated as exempt transfer. This was a proviso, guys. In this exceptional case, you will calculate capital gain. You will not exempt the transfer if these shares are transferred by way of gift or irrevocable trust. Understanding? This was the main section. Under main section, there was a proviso like this. Main section amended. Main section amended. Proviso removed. Now what is the situation? Any individual, any HF transferring any capital asset, including these shares. Any individual, any HF transferring any capital asset to any person, that capital asset can be any capital asset, including these shares also, by way of gift, by way of will, by way of inheritance, by way of irrevocable trust, will be an exempt transfer. This proviso is eliminated now. This proviso is omitted now. Now, till last year, the gift or irrevocable trust, if they were transferred by way of gift or irrevocable trust, no, till last year, that transfer was not exempt. You were calculating capital gains that time. But from this year onwards, even the gift or irrevocable trust is exempt if made by individual or HUF. Now, in your question, no, which you have solved, just now, no, we have solved this question, no, what you have written? I made you all underline also. Now write down. What would be the tax treatment? What would be the tax treatment if Mr. Ram transferred the above shares on 9th of September 24 by way of gift, will, gift / will / irrevocable trust, etc. In the bracket write down fair market value of these shares as on 9th September 24 was 1700 per share, bracket close. If the same question you had to solve with me in the last year, no, what we would have done, we would have calculated the capital gain on gift. We would have calculated the capital gain on irrevocable trust. But we would not have calculated the capital gain on will, because that proviso was applicable. But now that proviso is gone. Any capital asset, including these shares, transferred by individual or HF by way of gift, will, inheritance, irrevocable trust is an exempt transfer. So is it transferred in 24-25? Are these shares transferred in 24-25 by individual, by Mr. Ram? So this transfer will be exempt just like other capital assets. So write down with effect from, answer write down with effect from previous year 24-25 onwards. Transfer of shares or securities under ESOP, shares of securities received under ESOP, shares or securities received under ESOP or sweat equity shares by way of gift / irrevocable trust. Don't write will. because will was earlier also exempt. Don't write will, or if you want to write it down. Gift, irrevocable trust or will, because in the question I have given will also, no? Yes. Gift, irrevocable trust or will. Transfer of these shares by way of these modes by an individual or HUF is also treated as exempt transfer. Hence, no capital gain would be computed and charged to tax. On such transfer. On such transfer. Will you remember this much? See, if the examiner now wants you to make your life miserable, he can definitely exploit these points in the exams. So I am making you ready for the worst come scenario. See, I cannot, hide the things. That is not in my genes. That is not in my blood. Even if I, want to hold something and not to give it to you, I cannot do it. If it is supposed to be studied by you, if it is supposed to be known to you, it has to be known to you. Because in the examination, you never know. Institute is there. It can do any miracles in your papers. And if in the examination this thing is asked and I have not done, just imagine it will be a blunder. You lose your 5 to 6 marks in the exams. And just because of my laziness, that I cannot do. So even if it requires some extra efforts, I'll put it. Because that is for your benefit only. Okay. So, section 47, 5 transactions we have covered. 5, no, 4 transactions we have got. Conversion of bond debenture into shares. Conversion of preference into equity. Done. Then, partition is happening and HUF is transferring any capital asset on partition to the member. That is also exempt. And the fourth one, individual or HUF with effect from previous year 24-25 onwards. Individual or HUF transferring any capital asset including these type of shares by way of gift, will, inheritance, irrevocable trust will be an exempt transfer in the hands of such individual or HUF only from now onwards. Okay. What will be the cost of acquisition in the hands of the current owner in the last 2 transactions? HUF to member and Mr. A to Mr. B, gift, will, etc. Yes or no? So in the hands of the recipient of the asset, for transferor the section 47 will be applicable, but in the hands of the recipient 49(1) will be applicable. What will be the cost? Cost to previous owner. Any cost of improvement incurred by the previous owner will also be taken as your cost. Hello? Period of holding of the previous owner to be included in the period of holding of the current owner. Yes or no? Indexation only for your period of holding. But if you apply the Manjula Bin judgment, then indexation from the beginning. Wherever you will see 49(1), no, wherever you will see 49(1), everywhere this is to be done. Everywhere. Now see, there are more transactions in section 47. Now I will just tell those transactions. Those transactions are not that much important from exam point of view. If there is one holding company, 100% subsidiary of this company is there. 100% means all the shares of this company are held by holding company. Yes or no? No outsider involved. 100% wholly owned. All the share capital of the company is held by me. So I am a holding company. That company is my subsidiary, wholly owned subsidiary. So if holding transferring any asset to the subsidiary, or subsidiary transferring any capital asset to the holding, this transfer is also exempt. But these transactions will be very relevant when you will be in final CA, when you will be learning the assessment of companies and all. Yes or no? Right now, just have an understanding, basic understanding. Holding to subsidiary transfer, exempt transfer. Subsidiary to holding transfer, exempt transfer. Will you remember? Wait. Subsidiary should be 100% subsidiary. So if I say holding to subsidiary transfer is happening, holding to 100% subsidiary transfer is happening, 100% subsidiary, or 100% subsidiary to holding, the transfer is happening. This transfer of capital asset is exempt in the hands of transferor. Are you getting my point? So for the transferor, section 47 will be applicable and the transferor will be exempt. Yes or no? Wait now. Wait. For the transferee, now what will happen for them? For them 49(1) will be applicable. Meaning that whenever they will sell the asset, what cost they will take? Cost to previous owner will be their cost. Previous owner's cost of improvement will be taken as their cost. Getting my point? And wait. Period of holding of the previous owner also included in your period of holding. Indexation only for your period of holding. But if you apply Manjula Benn judgment, you will get the indexation from the beginning. Is it difficult? Just remember, that's it. This is not going to be asked in the exams. But still, you should be aware about this. Okay, but wait. If the transferred asset was a capital asset, in the hands of the transferor, so it should reach the transferee also as a capital asset. So the transferee shall not take that asset as a stock in trade. If for the transferee the asset coming is a stock in trade, then this exemption is not applicable. The transferor will be liable to pay tax. So for transferee company, asset transferred shall be capital asset and not stock in trade. This is the condition. Only then this transfer will be exempt in the hands of transferor. Bloody, you are giving the asset in the form of stock in trade and getting your capital gain exempt. If your capital gain will be exempt, then how that capital gain we will charge under in the hands of the transferee company? So do one thing, you pay tax on that capital gain right now. Later on, when the stock in trade will be received by them, no. So whenever they will sell as a stock in trade, we will charge PGBP income from them. But from you, we will charge capital gains. Getting my point? So the asset should be transferred in the form of capital asset. Only then the capital appreciation happening in your period, we can charge from them. No, only then we can apply 49(1) and all. And remember, the transferee company shall always be an Indian company. Transferor company can be any company, the transfer will be exempt. Hello, sir. But the transferee company must always be an Indian company. Why, sir? Why? Tell me why. What is the reason? Come on, tell me. If the transferee company is an Indian company, it will always be a resident. So whether these assets are sold in India or outside India, whether the income arising is Indian income, foreign income, this gain which we are leaving right now, no, along with your gain, it will always be taxed in their hands. But what if that transferee company is a foreign company? You have just now transferred the asset to foreign company who happens to be your subsidiary. Meaning you have opened a company outside India. To that company you have transferred your asset. Now that company is a foreign company. Whatever gain we are exempting right now, we will never be able to charge tax on that. Why? Because whenever that company will sell the asset will be sold outside India. Consideration will be received outside India. So entire amount will be foreign income. And in that foreign income, this gain which we are exempting right now will also be realized. We will not be able to charge tax on that. Forget about the gain happening in their period of holding. The gain happening in this period of holding will not be able to charge. If that company is a foreign company. So if you want your transaction to be exempt, under section 47, this transfer will be exempt only if the asset is transferred to the company. Transferee company is an Indian company and the asset is not transferred as stock in trade of the transferee company. Yes or no? That's it. If all these conditions are fulfilled, transfer is exempt, and for transferee 49(1) will be applicable. Will you remember this? Sure, everyone. From here we will continue tomorrow, and tomorrow we'll finish the major chunk of the, see, this chapter is almost complete now, almost complete. Okay, now tomorrow what we are supposed to do, tomorrow we are supposed to finish this exempt transfer. 2-3 points are remaining. Okay, that I will finish. The most important part of section 47 we have completed. Now very small transaction under 47 they are remaining. We are supposed to do the questions on section 47. Okay, then exemptions will enter into. Exemptions from capital gain, section 54. If you are doing the entire capital gain chapter and you are not doing the exemptions, no, meaning that the entire efforts and the hard work which you have done for capital gain chapter is wasted. Because without the exemptions, the capital gain question don't come in the exam. If 100 questions are asked on the capital gains chapter, no, out of 100, minimum 90 questions you will get the exemptions. So you must be aware about the exemptions. Getting my point? So tomorrow we are going to start with the exemptions also. We are going to solve many questions also. Tomorrow you will see in the capital gain chapter, no, you will have that proper hold tomorrow. And if the time permits, we will start the tax rates also. But if there is no time, tax rate will be done day after tomorrow. And day after tomorrow we are going to start with the new chapter. So tomorrow the major chunk of the chapter will be over. Don't worry about this. Okay. So we are meeting tomorrow at the same time. Okay. 3. Done. See you tomorrow.